screen share started in Discord. Get the link posted. What's up, Alex? How's it going? Just got to make sure that I get everybody in here. I did not post the link yet for my people. So there we go. And I'm just going to post it in the free chat as well. All right, there we go. So we'll give everyone a couple minutes to show up. I usually start this around 12:03, just so everyone has time to get in, get a drink, get settled. Hopefully get their attention off of whatever chaos they're focused on. Obviously, if you guys have any questions, feel free to ask ahead of time. What's that symbol there, Red Off? I don't think I've seen that before. That's pretty cool. It says online, but I don't know. It's like a little goggle thing. I was wondering if that was like a VR thing. All right. So again, we're just going to give everyone a couple minutes. Lee is also, Mad Maverick is hosting his coaching program as well, so we might have to move forward without certain folks. We got Snowflake here, one of the OG everythings. How's your week gone, man? Are you currently in the lumberyard? Not a horrible week? Okay, we'll take it, right? That means it wasn't great. Maybe. That's an assumption. I made an assumption. All right, we got about another 40 seconds or so, then we'll get rock and rolling. That's better than average? Okay. Well, I guess if the average is always horrible, then the average will be less horrible because the threshold will be lower compared to average, right? I think that's how stochastics work. It's a bell curve. Okay. I'm a bell curve. I gotta go to the gym more. All right, let's just go ahead and get rock and rolling. So this is Rags to Riches stream. It is a free live stream. The Rags to Riches program is a project we started a couple of years ago, basically just to demonstrate that you do not need to know a whole bunch of stuff and that you do not need to put all your money into speculative high-risk trades to make money and grow a portfolio. So over the course of the first 3 months, we tracked the original members' progress over their portfolios. They shared them all with a spreadsheet. I think it was around 90% of them had a green portfolio trajectory over a 3-month period, and the 10% who did not were kind of just doing their own thing or they weren't participating. So I'm just chalking those up to not having a green trajectory. So 90% still good, considering that's usually the percentage of people that fail. So since then, we've done a couple iterations here, but now we're in a different market. We're dealing with a different audience. So the goal here is to demonstrate not just the value of dividends and passive income, but also some of the psychology and the strategy behind building a portfolio. So on the speculative side, yes, it's fun. I was up, I damn near doubled it yesterday, so I trimmed it back down. I'm just using $100 now. Today I got 31.11%. I actually trimmed it down a little bit below 100 by accident. It was down to 99.51 when I pulled the money out. There must have been fees. I don't know. And then we made the money today on the morning trades, and then we're done, right? We had a defined cutoff point for that. So once that's done, right, we have to also consider what we're going to do with those profits, and that's where passive income comes in, and that's where all the other stuff that we focus on comes in. So what I want to point out today is that trading and investing specifically is a non-ergodic process. So is everyone here familiar, or is nobody familiar with the term ergodicity? Put a 1 in the chat if you know what it means, a 2 in the chat if you don't. I'll write it here. Don't bother going to Google it. I'm going to go explain it and specifically how it applies to the market. I'm just curious because it's not a word that I see every day. Ergodicity. Yeah. All right. Okay, so basically that just means that an individual outcome, an individual path may differ from the average, the aggregate, right? It's a term from statistics or finance and statistics specifically. And basically there's 2 types of average when you're looking at growth or some trajectory, right? There's the time average, which is the path of return experienced by you, or one person or one portfolio over a timeline. And you can think of the chart here as a time average as well, because if you add like a simple moving average, for example, or an EMA, an exponential moving average, this is a time-based average because you're seeing price over time. The buys and sells, the candles themselves, individual candles, like I'm on the 2-minute chart, this represents 120 seconds worth of trading data, right? This is another 120-second period, and this one and this one and this one are all different. So these are all time, it's a linear thing. If I switch this to a tick chart, time is removed from the equation. I'm going to do one tick here. Time is removed, and all we see is each transaction as it comes in, right? So we're removing time in this case just to recognize the role that time plays on a candle chart. So let me go back up here to the 5-minute. And then the other type of average is an ensemble average, and that's just saying this is the average outcome for a large group or kind of everybody at one specific moment. So, for example, this chart right here, 1209, right? This is the end result. It's not the average, but it's the end result of every transaction that's happened up to that point in time. Okay, so if we just freeze time right now and we look at 1217 and we lock in every transaction that's happened today, we'll see that the last one in this case was 1210. Okay, and then we can add something called the VWAP, which is the volume weighted average price. It's a slightly different calculation than just a raw average, but basically that's the aggregate average of price up to that point. And this is why you don't see it on a daily time frame or higher, because it only calculates based on transactions that happen that day. Okay, and the reason that I want to point out the difference between these two is because this transaction right here, this $12.30 transaction for 1,400 units, is not in alignment with this average. Okay, so whoever bought that or sold, because every transaction requires both a buyer and a seller, has a different value, a different assignment of value than the average. So in that one specific state, you could argue it's not ergodic, but it's about the averages. So if the overall market goes up, for example, right, and my portfolio goes down, that's a non-ergodic outcome because my average doesn't align with the ensemble average. The time average and ensemble average are different, okay? Now, that's relating to a portfolio compared to the market. So let's look inside the portfolio itself. So let me just pull up a notepad here if I can. It's for my one-on-one, so I'm just trying to get in case there's anything sensitive on there. It's not, it's just, I was talking about the 3 rules that I look for investments. So if I look at, let's say I start with $1,000, right? And then I win 10%, and then I lose 10%. What are the outcomes there? And then I'm going to do this in the opposite order. Okay, I'm going to lose 10% first, and then I'm going to gain 10%. Okay, most traders assume that you should be break even if you lose 10%, then gain 10%, but that's not how math works. So if I gain 10% from $1,000, I have $1,100, right? Then if I lose 10% of that, I'm losing $110, which brings me down to below 1,000. Let me just pull up a calculator because my brain is shut off after this morning. Minus 10%. It's gonna be 990. I thought that was right. I thought there was a decimal in there somehow. Now, if I start with $1,000 and I lose 10%, I'm down to $900. And then if I start with $900 and gain 10%, I'm at $990. So in this case, they work out relatively similar because we're just doing one instance. Does that make sense? So again, I'll just run through it again. 1,000 plus 10% is 1,100, minus 10% brings us to 990. 1,000 minus 10% brings us down to 900, plus 10% brings us to the same 990. The problem with this, though, is if I compound it, right? So if I do 1,000 plus 10%, plus 10%, plus 10%, I get equals 1331. Okay, and then if I do 1,000 minus 10%, plus 10%, plus 10% equals plus 10%, plus 10%, 1089. And then if I just move that negative sign over 1, right, you'll start to see something here. Minus 10%, plus 10%, right? I should get 1089, right? Minus 10%, plus 10%, 1089, right? So this is just it's the commutative property, right? And in this way, traders are right. But the difference here isn't in, the order of operations for adding and removing this win. It's the fact that you're not getting back to $1,000, right? So if we just go back to this first example here, if we start with 1,000, we gain 10, we lose 10. No matter what order that happens in, we still end up at 990, which is 1% less than we started. And that is a form of slippage, right? So when you're talking about ergodicity, if you take a loss early in your trading experience, which most traders do, then that inhibits your growth trajectory pretty significantly over the long term. And that is because if, let's say you lose 50%, right? Minus 50%, that brings you down to 500. Guess what happens if I need to, guess what has to happen to that 500 in order for me to get it back up to $1,000, right? It's a no-brainer. I have to double it. So I need 100% to get back to 1,000, right? If I lose minus 1%, for example, just $10, that would be 990, right? 10 divided by 990 times 100, I need a 1.01% profit to get back to the 1,000, right? So we don't want to take a 50% loss early on. We don't want to take a 20% loss early on. We don't even want to take a 10% loss early on. And that's how I'm able to build these small accounts so efficiently, is I just don't take big losses unless I have to. And those who were watching the stream earlier today, you guys watched me take 10% losses. I was being very aggressive, and part of that was just to demonstrate this, for example. This account would have been up to 160 by now. And I'm using a very small amount of money here. And I use the smaller accounts on faster trades to demonstrate the same effect over a smaller amount of time because I'm live streaming. But if you scale this up to passive options income, you got the wheel, you've got spreads, you've got leaps, things like that. You got beta hedging. You apply this to compound reinvesting. For example, Tesla, right? If you're taking losses in the market, you typically don't need to go for yield traps. Because at the end of the day, what you're doing there, let me just start fresh here. Okay. I'm going to give you guys a crash course here into dividends and losses. So when a company gets big enough, they can offer a piece of itself to the market. Okay, this is what we call a share, common share. All right, this includes a piece of a dividend. Okay, so part of the share value is a dividend, part of it is the actual share. And then what happens is you hit the ex-div date, and the dividend portion is trimmed off, and that's converted into a cash payment later on. Okay, so div, and then there's the share. So this pays later. Oops. Okay, and the idea here is then to reinvest that money into that stock or other stocks that are valuable, to reinvest the cash form. Now the problem here is that you've just triggered a tax event. And the share now has the burden of regrowing that value, right? Because you just lost a piece of the value of that share from the adjustment. Okay, so successful companies that have good fundamentals and successful ETFs that have good growth and recovery rates are very easily able to do this. But if it doesn't, let's say they pay out too much, like Tesla, it's a yield max ETF, or Coney, and the share doesn't recover that price, and then you hit the next adjustment, okay, they're going to have to dip into this share value, and then you get something like this. And then that share is then, or that dividend portion is then, converted over to cash payout and all that good stuff later on in another taxable event, right? So the share value will get smaller and smaller each time there's an adjustment. And if they can't recover that price through, gaining investors and positive circulation and higher price negotiations, then the share price will continue to deteriorate, and then they'll go sub-dollar and have to do a reverse split or something like that. For those that successfully recover, they don't have that issue. So those are the ones where you're actually making money. The ones where the price just doesn't recover, you're not really losing money in all cases, but you are certainly shuffling it around and triggering taxable events. Okay, so when that happens, what we have here with a decaying share value, okay, we've got the taxable events to consider, and we've got the decline in share value to consider, and then we can sell those shares for a taxable loss, capital gains loss, short-term capital gains loss, assuming you've been holding for less than a year. So this offsets these taxable events to an extent because you're reducing your taxable your capital gains burden by selling a capital gains loss against them. Okay, and by doing that, if these are disposable shares like a yield max ETF, then you're protecting your larger, longer-term, higher quality investments that you're using this reinvestment cash for, rather than just buying more of these trash ones. And that's kind of the name of the game for building a dividend engine, because the goal here is to amass as many of those higher quality shares as you can without paying more for them. So if you can offset your taxes by selling these disposable shares and offsetting the capital gains event, the taxable event, you basically just get that recovery money on the underlying shares in cash form on the next one. So it's like deferring a paycheck. You know, they hold back a week. You're kind of doing that as long as the shares recover that value. Okay? So basically, you're putting money in, sorry, and then you're either getting a cash form and an increased share value, or you're getting a decreased share value and the same cash form, and you're just reinvesting the cash into higher quality stuff, all without getting any more tax burden. Okay, so we have to balance that out. Otherwise, we're either losing money or we're wasting money. So does that make sense so far? I know that if you're new to dividends and stuff, that was a really quick explanation. But I hope the concept makes sense. If you're not familiar, I'm more than happy to slow down. But I just want to make sure that everybody here has an understanding of the goal that we're trying to get to. Because the goal, again, is to amass a large net worth or total cap value of high quality, stable assets over time, so that you can then take that and bring it to a specialized lender like Morgan Stanley and do something like an S block. It's a securities backed line of credit, so that you can live on that debt at maybe a 3% APR, and then obviously principal has to be paid as well, instead of taxes. Right? I don't like paying 30% taxes. It's just not a good idea. Plus, I'm not getting more out of the government. So this is the end goal. This is the pre-end goal. This is the strategy we use on a yearly basis to mitigate those tax burdens. And this is the day-to-day or week-to-week or month-to-month goal in how we actually do it. So this is the action plan. Does that make sense? Just slap a 1 in the chat if it does, or a 2 if it doesn't. And if you do put a 2, just let me know kind of what area there's confusion in. I'm trying to find that line between not just repeating myself every week and then also making things make sense for people. Because a lot of people think you just buy a stock and they pay you to hold it, and that's not quite how it works. You're not really gaining money, because if the company just keeps reducing the share value for those payouts, you're just moving money into future payment, and then you're paying taxes on it for no extra reason. So we really want to focus on companies that recover the share price, because that's where the profit actually comes from. It has to outperform the adjustments. Otherwise, it is a garbage stock, which we use in a disposable manner to offset losses elsewhere, or gains elsewhere, sorry. And if you're already taking losses, like let's say on the speculative side, you don't want to do that with any of your shares. So you should only be holding, in my opinion, higher quality stocks in that case. So quick show of hands here. Who's net positive for the year? And who's negative for the year? Put a 1 in the chat if you're positive for the year, 2 if you're negative for the year. I'm not too interested in like wash sale stuff or any of that right now because we're in July, about to be in August. But just, I'm curious. I'll put a 1 in the chat. I'm net positive for the year. And I mean everything. Investments, speculative trading, all the good stuff. Or did I put you all to sleep? Here, I'll put a chart up so it'll reinvigorate you guys. Let's go to SPY. We'll do SPY. We'll do the tick chart. We'll add the Heikin-Ashi candles. We'll put a bunch of lines up there. There you go. I'll make it look sophisticated. see. There we go. Okay. Might be negative overall. Okay. But there's no wrong answer here. I'm just curious. So if you are net negative, are you holding on to dividend positions which are losing value? Oh, you know what? I should have had this on the chart this morning when I traded to make people think I know what I'm doing. So this morning in premium, I traded without a chart. I did the old order book here. Just traded like that for a little bit. Just to show that like you don't really need patterns and all this complicated technical analysis. You just have to understand how the market works. For the speculative side. Rex Rich's account is good, but you know how I'd be experimenting in other accounts. Yeah, I hear you. Well, weren't you up like 600% or something on your other smaller account? And I know you just opened one for your daughter, or had one open for your daughter. I think you said that one was doing pretty well too. It's okay to experiment. That triggered a vacation to appreciate it. Okay. That's good. You and the doctor both just slammed a wall of success and then just took a step back. I love it. That's good stuff. Does it feel a lot easier now that you're not trying to be right all the time? I think that's the biggest obstacle is people just try to be right, and it makes sense. We're human, but that obviously just gets in the way. One 600% day makes you want 5 a week. Absolutely. And then you just give that money right back to the market. It's not worth it, man. Like you guys see it when I'm trading the small accounts. I get some pretty decent profits, and sometimes I take bigger hits because I'm being a risky, silly goose. But I'm not undisciplined enough to view it as anything other than proof of concept, right? Like if I were to go to SPX right now, okay, there's no order book, no volume, so I'd have to just base it on what comes in, right? And I don't know that until I get hit with it. Second, these contracts are way overpriced for this size account, which would force me to go far out. So I might make a profit, I might not. It's going to be an uphill battle either way. And it's just, it's difficult, So rather than just being tempted into that, which, again, I can trade it because I've been doing this for a decade and a half. But if I'm a new trader, something like that's going to shred me, and I'm just going to walk right into it completely willing because I want to make more money. So until you get that demon tamed, passive income, couch profits, compound reinvestment, those are all going to be much safer vehicles for wealth. And also understanding that this is a non-ergodic process. When you're dealing with a portfolio, right, which is a persistent value, meaning that where it left off is where it picks up again the next day, the impacts of that are multiplicative. So your gains and your losses will compound based on the remaining balance before it's applied. So again, start with $1,000, gain 10%. That's $10, or sorry, $100. If you start with $10,000, that's $1,000. So those two numbers are not the same. Okay. If you lose 10%, you're down $9.90. You lose 10% of that, you're down $9.90 below that. So you're down to 101.10 or something. Or 901.10. Jeez, my math is all over the place. So severe percentage drawdowns increase the amount that you have to recover, which should not be an increase in risks you take. It should be an increase in the time it takes, because this should just be a function of time. And obviously, if you've blown up an account, that's it. You just sometimes, like if you go below $1, you kind of have to add more money, because you can't trade a sub-dollar stock on Webull unless you buy 100 shares, for example. So there is a point where the ruin is too severe, but it's below $1. So if you only have $20, you can still grow a portfolio. It doesn't have to be speculative. It doesn't have to be options. You can still grow a portfolio by accepting compounding small base hit profits or buying and holding higher quality investments, which might be hard to find for 20 bucks, but you get the idea. Just taking those bird in the hand profits more often than not. And some of the stuff is just, it's going to be overwhelming for a new trader. You have a default set of behaviors, perceptions, and reactions to things as a human. And until you crack open the book and read the manual on what it means to be human, you're going to be a victim to those forever. So that's why I focus on neuroscience. That's why I focus on the psychology behind it all, not the woo-woo feel-good stuff. I'm talking literal, like, this is the part of your brain that does that. This is the part of your brain that does that. This is what most people are driven by. Is that true for you? Answer the question for yourself. Let's isolate this part of your behavior and see why this response is occurring in response to this specific trigger. And then what specific boundaries can we put in place so it doesn't influence your decision making? How often are you doing self-awareness checks? Are you at baseline right now? Or are you stressed out or anxious? Does seeing this on a chart moving quickly, does that cause a response? What state are you in, and how are you going to perceive things based on that state? And if you can't answer those questions, then you got to spend some time focused on stuff that's not a chart. And that's why I try to reinforce that stuff. What's up, Redoff? Sorry, let me catch up on the chat here. New to stock, started 2 days ago on stocks. Some of this is confusing. I use Cash App to do stocks. Well, first off, welcome to the market. You're in a good place because we start with the common sense stuff first. And a lot of people just jump right into speculation because they want to make money, and that is what destroys new traders. 90% of traders fail because they can't break that cycle. So rather than just jumping into that, let's talk about a more sensical approach. I'll start fresh. You're getting a brand new understanding. Ready? I got a very straightforward process for everybody. There you go. It's me. I don't approve use of my photo without written consent. All right, so let's break down the process. You invested $10 into stocks. You earned $11.18. That's awesome. Did you use an appropriate position size? Did you scale out, or are you still in? What was your confidence level? Were all your decisions made based on objective things, or were your feelings and risk perception part of that equation? So I'll give you the investment portfolio approach first. I'll give you the crash course in that, and then I'll give you a crash course into market mechanics if you'd like. You're going to be here for another 20 minutes. I'll walk you through it in less than 10. You sold at 9 a.m., should have kept it going to 10 a.m. What is that based on? It went up. So after the fact, right? But you weren't saying that at 9 a.m. because you sold it, right? And if it went down, you probably wouldn't be saying that, I assume. So something happened at 9 a.m. and that caused an action, right? So your capacity to not take that action was exceeded by whatever information and thoughts and processes you had at 9 a.m. That's when you said, okay, I'm going to push the button. And then you did it, right? And you made a profit. Oh, your friend's Alec? Okay, well, glad you guys are here. Thanks for hanging out. That's good stuff. You guys can pop on the mic, too, if that's easier. As long as, like, everyone's not talking at once, I don't mind. I'm recording these, so I've recorded on my end, so you guys will have the, your voice will show up on the recording. So let me walk through the portfolio structure first. So we've got a couple decisions to make. First, are we financially secure? outside the market, or are external financial pressures going to cause us to make decisions in the market? Like, do I need to pay off a credit card? Am I facing an upcoming uncertainty in my budget and I need to address this, and then therefore I need to take risks and make more money in the market, right? Is that going to impact my decision making in the market? You could have made more profit at 10 a.m. You also could have made profit on SPY, right? Or the 1,000 other stocks that you weren't in. That's okay. There will be so many more opportunities. It really doesn't matter. You know, at the end of the day, you made a decision, and that's what we have to study, right? Not the chart, because here's what happens, right? Let me just get this off the screen here. Here's how it works. Let me get all this other garbage off the screen. Do you feel the same way about your stock that you brought from $10 up to $11.18 as you do this one here? Do you feel like you missed out on this stock? You invest in Google? Okay. Are you investing, or are you just buying and selling? I like Google as a long-term investment, like decade plus. But if you're basing it on charts and just getting in and out, that's speculating. And that's okay too. We just have to make sure that we've got a plan for what we're doing. You bought and sold when it reached 11. Okay. So now you're basing it on something specific, right? You're saying it reached $11, therefore you took the profit. Is that why you sold it, or was that just when you sold it? I'm not trying to pick on you, by the way. This is good stuff to dig into because this is stuff that traders need to think about. They need to focus on learning about their responses to things rather than just looking at charts all day. Okay, so it's $11 is why you sold it. That's good. So when you got into the trade, was that a defined target, or were you just saying, okay, $11 is enough, I want to take the risk off the table? Yeah, I gotta agree with Alex on that. I think just having a better broker. I don't like Cash App or Robinhood personally. There's just a lot of stickiness on those. Schwab. I'll never say Schwab the right way. It's Schwab. Cash App is simple for beginners. Absolutely. What if I told you only need to buy and a sell button? You don't need anything else. Well, other than a way to look at tickers, so you can look up the tickers. Yeah, simple as hell. I don't need the chart. I showed that this morning. I'll pull up the Webull comments and trade. Let me find one here. I'll do a live trade right now for you. Don't like that. Don't like that. Boom, I'm in. Now what? What should I do? Should I buy it? Should I hold it? Should I sell it? I gotta have rules, right? Well, I can already tell immediately this isn't going the direction it's going to make me money. So why not just get out? Oh, I just mean hold. When I say hold, I just mean I'm not taking action. I'm not selling it. I'm just hanging on to it. But what happens if I don't make a decision here? Right? The price is going to go up, down, or sideways. I don't control that. I don't control whether or not I'm right in the end. I only control whether or not I'm exposed to risk. So you can see right here, I'm down 10%. Should I make a decision now? Or should I let it drop to 20%? Should I let it recover and go back up? I don't know what it's going to do in the future. I only know what it's doing right now. So this is dangerous, right? Because I'm just getting into stuff blindly, which is fine. You don't necessarily need technical analysis. But the problem is I'm remaining exposed. And what this means is that I am violating one of the principal concepts of risk management. So let's say you've got a brokerage account, right? In that brokerage account, there are two sections. Okay, well, maybe I drew that a little bit too wide there. Let's say this is your brokerage account right here. Okay. And then let's say here is the market. Okay. Broker. Well, I'll call this the portfolio, right? Portfolio and the market. Okay. Now, in the portfolio, your broker has little buckets that things sit in, right? It's got cash. It's got shares. Okay. And they hold on to stuff for me like a savings account. I tell them what to do. They go to the market and they try to do it to the best of their ability. Okay. Now, if I want to turn cash into shares, I've got to send the cash over to the market, and guess what happens there? It changes value, right? So when I have cash, it's static value. It's sitting in my portfolio, just like I have $91 sitting on my desk, cash, right? It's just sitting there. I'm not doing anything with it. It's not changing value. There is a slow decay of inflation, but from a day-to-day perspective, it's not changing value, right? Now, when I buy shares in the market, then it's in a dynamic state, right? Meaning that its value is going to continue to change the longer I leave it exposed to risk. So if I look back here, you can see this went all the way down to like 17% below. Now it's at 12 or 13% below. So I'm giving back some value that I made previously because I'm just holding this in this dynamic state. It's going to keep changing, right? So I don't choose which way it goes. I don't choose whether or not it goes up or down in my direction or if I get outvoted. And I can have all these feelings and opinions about where I want it to go, but I don't have any control over that. What I do have control over is whether or not it's in this fixed state or a dynamic state. Does that make sense? So I can buy stuff, but then I also have the responsibility of choosing to transform it back into a fixed state. Ideally, it has more value than I started, but sometimes it doesn't. So I have to choose the range at which I'm allowing it to go in both of those scenarios. But I don't need anything fancy to do that. I just need a buy and a sell button so that I can make decisions about how far I'm willing to let these things go. Now, in this case, I'm about 10% down, and I'm using 90% of the small account to demonstrate this, and I'm not sweating at all because I know I can make it back. Right now, it looks like it's recovering. It's coming back up to 4%, 5%. So let's see where we would cut this if it continues to move up. If I can make a profit out, I'm going to be grateful for that, and I'm going to take it off the table. And you can add in some analysis, and you could say, yeah, there's more liquidity up here, and price naturally seeks liquidity. So therefore, if we get over 40 cents, which is this wall, we should push up to 44 cents, and that's above my average. So I should make a profit on this as long as we get ask dominant volume. That part doesn't have to be complicated. Do I trade negative risk reward? No. Normally I don't. I cut things at like 2.5% in most cases. I'm just doing this for demonstration so I can show that, you know, if we don't take action, then the price will go wherever the price wants to go, and we don't control that. I control whether or not I'm exposed, so I'm demonstrating inaction and kind of the impact that has. Because that's where most traders are going to start. They're like, oh, I'm 20% down. Let me double my position, right? And that's not the solution in most cases. So right here, for example, we just barely peaked over my break even, and I didn't lock that profit. So the other part of me is also kind of hoping this brings some stress up or anxiety in people who are watching because we don't see a chart, right? Which is what people are very dependent on. That's the edge of the pool, right? We always latch onto that. And then that reinforces our desire to be right and our biases. And then we also see a number that's changing very rapidly in both directions. So I'm kind of hoping this will bring a little bit of stress to the surface for certain people who are watching. So if it does, go ahead and put a 1 in the chat. Are you guys anxious watching someone else trade without a chart, without a reason, without a plan, on money that's not yours? Because I did that when we were in Chicago. And Austin, the CEO, the guy who started this whole community, was literally like jumping over a desk, freaking out. Like he was having a day. But he doesn't understand why, right? just join. I don't know what's happening. What do you mean? Oh, I'm just demonstrating. This is just demonstration. Like, this is what happened. This is the circumstance of the market. Like, if you look at this, right? I got in here, and the price just chose a direction, and it went, right? I kind of randomly picked a ticker. I just wanted one that was active, just for disclosure here. I just basically YOLO'd into it, and now I'm just showing what happens if you don't make decisions. There's no bad questions here. Ask every question you have. Portfolio is just an account, basically. It's just what the broker holds for you. So like you start up a savings account, you put cash into that savings account. That's your cash, but the bank is holding it for you. And the bank may do things with it, like they might give you interest on money you've deposited because they're going to use your money and loan it out to other people. And then they're going to collect interest on those payments for like mortgages and things like that. And then you're entitled to a piece of that since they used your money to loan it out. Now you can still withdraw your money. It's still yours. They'll just have to pull it from somewhere else if you want it. That's basically the fractional reserve banking system, but I don't want to go down that hole today. So a portfolio is kind of the same thing, but instead of just holding cash, they also hold shares. They hold options contracts. They hold bonds. They hold warrants. They hold all the other stuff that you can buy and sell within the market. Crypto, futures, all that stuff. So it's a good question. We want to understand what a portfolio is before we, make decisions about it. Is what free? What's up? So again, we've got cash and we've got shares, right? Cash and then shares. Terrible Renaissance era drawing. All right. This is a fixed state. This does not change until we put it into a state which allows it to change. Then we've got some choices to make. A, how much cash do we convert into a dynamic state at any given time? How long do we let it go? There's a hierarchy of risk there. I use a triangle for that. You've got range, size over range, right? All right. Larger amounts of money, we tend to not go very far, okay? Because we don't want to risk a large amount of money over a big distance like that. Smaller amounts can run very, very far, and that's okay. Can I do fractional shares on the broker I'm using? I don't think Webull allows that, but I also don't think we need to really deal with larger stuff. So basically, if, like, for example, let's say I want to trade a Tesla option right now in this small account, which is back to $100, right? I can't do that because doing that would force me to buy a contract that's super, super far out, and then I would have a lot of difficulty managing my risk because it would be too big for that account, right? And it would be far out, so my probability of making a profit on that is very low. So I choose not to buy Tesla contracts on this account. It's just not proportional. And this also applies to investments. So if, for example, we've got an investment portfolio and we're splitting it up into 10% blocks or whatever, and then we're combining or dividing them as needed. Right? I'm not going to draw all 10 equally, whatever. You get the idea. There's some number of slots here. Let's say each of these are 10%, roughly. And then we're taking our consistent contributions and we're splitting 70% of those into this stuff, and then 30% off into another area for speculation. Okay. We then need to determine whether or not this warrants taking action. So if I'm putting, let's say, 500 into this as a consistent contribution, all right, 350 would go into here. So then I would convert that into $35 chunks, basically, for each of these 10 blocks, if that's my structure, and that's just a blueprint. So I would add 35 to this, 35 to this, 35 to this, so on and so forth, right? All the way across all those spots, whatever our allocation structure is. So in this case, let's say I wanted to buy a share of Vanguard, VOO. It's a $600 ETF. $35 doesn't get me there. okay? But it does provide $35 towards that 600, okay? I'm not going to use that 35 and then go buy 3 more shares of this one just because I have an extra 35, because that throws off my ratio, right? So instead, I would look at this 35 and buy maybe a share of Schwab, SCHD, or Maine. I think that might still be below 35. I'm not sure. I'd have to check. Maine. So each of these has an intended end place, right? It's got to land somewhere. And then, of course, I like Pfizer personally. And then we've got the other stuff, right? Whatever you decide to invest in. But $35 may or may not get me a share out of each of these. So worst case scenario is I just have some cash sitting on the side, and then I get what I can with the allocations I've given myself. Speculative trading is the same way, right? If I can't afford a responsible options contract because my portfolio is too small, I just don't trade it. If I can't afford a high cost ticker, I just don't trade it. Okay? I'm only going to trade what I can, but only if it's quality. Okay, so I'm not going to go buy a 10-cent stock for no reason and then hold it for weeks and weeks and weeks as it bleeds out and delists because I understand the risks there. I'm just going to get in and out if I'm doing that stuff, but I'm going to keep the position sizes relatively small. Now, obviously, that's not what I'm doing here. I just put 90% of this portfolio in for this demonstration. But the goal isn't to just throw more money into whatever we can and then hope something sticks. Have I ever traded prop firms? Prop firms are almost always a scam, and I'll tell you why. Because again, I always back up what I say to the best of my ability so that you guys can get a better understanding. So let's say I'm a prop firm, okay? And I want a whole bunch of people to come in and I want to make money, okay? What I'm going to do is I'm going to collect fees. I'm going to offer some free services, but mostly I'm going to collect a bunch of fees because this ain't no soup kitchen, right? And then what I'm going to offer in exchange for fees are shiny interfaces. Shiny. I'm going to offer simulated data, but I'm not going to tell you that because I want that data to make you feel good. Okay? I want you to win a bunch. And then I'm going to put a challenge in place so that your identity latches on. Okay? Because I know you're human and I want to exploit that. And I'm also going to put you under a time crunch. So urgency is another item here. Okay? This is a recipe for self-destruction. Okay? But I'm getting those fees. So guess what's going to happen? You are going to pay me, right? Because you like what I have to offer and you like the appeal of potentially getting access to a lot more money than you have now. Otherwise, you wouldn't be in the market. And then I'm going to give you a shiny interface, simulated data to make you feel good about winning, but I'm going to make it challenging. I'm going to say you have to follow these rules. You have to achieve this number of milestones within this amount of time, which may or may not be a factor. But there's some hook there that keeps you coming back, right? People like puzzles. It's just who we are. And then, oh, sorry, you didn't make it. So you gotta pay more fees, try again. Right? If you can follow the rules, sure, I'll let you through. But 99% of people are going to just get stuck at the paywall, just paying fees over and over and over. You're paying to trade on a paper account, basically. And then when you get payouts, right, that's the other tier of membership there. We're both making money because I'm taking 30% of what you make. Mine. Right? And then there's still contingencies and restrictions. So if you mess up anywhere along the way, I can kick you out, right? I hold all the cards here. You have no advantage. But you haven't yet realized that you know how to trade. So why not just go trade for yourself at that point? You can use a paper account. You can save all the money. The logic of a prop firm does not make sense. Okay? That's not to say they're all scams, but a lot of them are. And it's very difficult and kind of nonsensical to trade with them, in my opinion. Because the only thing you're getting is access to more money, and then you got to pay more money out of your profits in the same amount of time it would have taken you to probably just learn how to trade and compound a smaller amount of money into whatever number you're seeking. It just doesn't make sense. And then when you make those payouts, you still got to pay the government. because that's still taxable gains. So if these guys take 30% and these guys take 30 to 35%, you're not getting a good hourly wage. Oh, you gotta leave? Okay. Yeah, I mean, this is recorded. I'm actually going to jump off here pretty soon as well. But hopefully this is a good enough explanation of why we have to be deliberate with our money and we don't just want to jump into stuff without a plan. So in this case here, you can see this is now 36% down, right? And I'm not worried about that because I know I can make it back. But you can see I started the day with $100. I got it up to 130. And then guess what happens as soon as I didn't have a plan? I didn't make decisions. I didn't commit to my set of rules. But I also didn't use it. I mean, you don't need a chart or anything like that. But that's where most people are going to focus. So they're going to come over here to the chart and be like, oh, it's going to bounce. I see, this kind of extension has to bounce. It's going to retrace at any time. And then they'll just continue to hold anyway. So rather than doing all that, and rather than taking a 40% loss, accept a 2% loss, accept a 2.5% loss, accept a 3% profit, accept a 5% profit. If you do that more often than not, and you're trading things that make sense, meaning that the price action is pushing into concentrated areas of liquidity, and you don't need a whole bunch of technical analysis in the mix. Again, I'm just going to take this off. I'm going to take it out of the equation, right? Because I don't like that as a distraction. And just focus on using responsible position sizes, accepting profits, accepting losses, not living in denial, and not compromising. And more importantly, focusing on how you respond to things and how those responses influence your decisions and how your decisions and actions are in alignment or out of alignment, you'll have a much better time in the market than 90% of traders who just jump in and fail. So if you want to trade, you have to learn about yourself. And I can't give you the answers because I'm not you, unfortunately. I can read the manual. I can tell you all the parts of the brain that are responsible for certain things. I can tell you about neurotransmitters. I can tell you about conditioned behaviors. And I can give you structure and schemas to work with, but I can't make the decisions for you and I can't push the buttons for you. I can show you what happens when you don't. I can also show you what happens when you do. You make consistent payouts from prop firms. Do you think I should stop? If you're making money and it's worth it for you, and then you're also able to pay taxes on it and not just trade on your own, I mean, I feel like it's your call, but I would personally just trade my own account. Why would you have to beat the market? I don't understand. What do you mean by that? I'm not disagreeing. I'm trying to get clarification on what you mean. There is I will say that just on a separate note there is a strong misconception that trading needs to be effort, right? Day trading specifically. You don't need to put effort in. The goal is to put less effort in. You don't have to be a superstar at pushing buttons or analyzing charts. It really is a game of less is more. And 90% of the effort is really just finding out how to get your identity out of the mix. You don't have to sacrifice your identity or lose who you are as a person. That's not the goal. It's just to become aware of who you are and how those character traits impact your decisions. But it's certainly not a matter of just looking at more charts and learning more analysis and putting more indicators on stuff and plotting more lines and getting more time with the market in front of your face. That's not the solution. More charts, yeah. It's really not. Prop firms offer high ROI. If you're trading in the real market, for example, the Nasdaq goes up 30% in 1 year, you'd have to beat that for even... I don't think that's true, though. On a real account, I can outperform 30% in a year without all the other stuff. I think prop firms just add another layer of abstraction and another layer of complexity and another layer of cost on top. So every dollar you lose by giving it to the prop firm or by paying extra taxes is money that you could have reinvested into your own growth earlier in the trajectory. Does that make sense? I'm not saying it's wrong or that there's not a use for it. I just don't think that prop firms are as beneficial as most people interpret them to be. Yeah, 30% on a well-averaged dividend account. You've seen me do it. It's the best possible evidence there, Snowflake. You saw yourself do it. But it's true. I mean, a lot of you guys, when we first started the Rags to Riches, you guys were crushing it without putting in extra work. So again, in this case, I'm demonstrating very deliberately here what happens when you don't have structure, when you don't have rules. You know, we made the choice. We put this cash into a dynamic state and we left it there. And at that point, it's subject to the circumstance of the market. So we have to accept smaller losses and we have to accept smaller profits, and we'll have a much, much better time. So you guys consistently actually beat the market like S&P or Nasdaq %? Yeah, absolutely. Here, let's look at the S&P, right? Well, let's look at the index. Let's go up to monthly. Okay, so let's look at July 2025 to July 2026. So is it this one? Okay, so let's say we opened here and we're here right now. Let's go to the high. That's 23.17% in a year. I have absolutely destroyed that. Hell, this small account even was up 30% earlier today, or 35. Yesterday I doubled it. Like, that's obviously in a small account. Larger accounts, yeah, I still tend to outperform that. But at a certain point, you're not looking at speculation like that with larger dollar amounts, and you're not seeking large returns on 7 or 8 figure assets, because you want those to be stable so that you can leverage those for collateralized debt in the form of like a securities-backed line of credit, and then living on the tax-free debt at a much lower APR than you would normally pay on taxes. So, having 8 figures, for example, you don't want to pay 35% tax on a 26% gain on that. So if you have 8 figures, you're not actively trading that kind of money. Most of it's in passive income. Most of it's out of the market because you want it in collateralized debt form. Yes, every year I beat the market. Absolutely. Because I hedge and I diversify and I manage outside of the market as well. Early on, the first year, no, absolutely not. I got crushed. I lost 80% of my money the first month because my mentor thought it was necessary for me to be humbled, and I don't think that's the case. I think it's more important just to focus on yourself as a human and to identify responses to things and how they impact your decisions. Once you figure that out and you put specific guardrails in place, it just becomes a function of time. Just speculation is not the answer. Just passive income is not the answer. We also want diversified revenue streams outside of the market. Am I Warren Buffett? No. I don't like Warren Buffett. No offense. I like a lot of the stuff he says, but a lot of his advice is also super toxic and destructive. I think in the old world, that model makes sense, but I don't necessarily think it's adaptive enough. Yeah, hedge, beta hedging. I want my portfolio stable. I don't want it exponential in one direction or the other. When it comes to large accounts, I just keep it stable. All right, Snowflake, take care of yourself. Because what I want to do is I want to take those assets, right, and I want to bring those to a specialized lender like Morgan Stanley, for example, and I want to take out a securities backed line of credit and pay 3% APR plus principal instead of paying 35% and then trying to expose all that money to risk in the market. Because that's how you get destroyed. That's how I got to be where I'm at. But the threshold for that to be worth it is around 5 million. So getting up to 5 million requires a slightly different approach. It's a more active process. Oh, you can't hear me super good? Is anyone else having trouble hearing me? Okay. Thank you, Metster. Just making sure. Okay, it could be. That I don't know. So on smaller accounts, the main concept is to just eliminate drawdown as much as you can, mitigate it. What would you say really boosted your trading? I would say position sizing, once I figured that out. Using responsible position sizes and consistently locking in profits are definitely two of the bigger applicable concepts. But a lot of it, I would say the thing that really cemented it was just my self-awareness, just figuring out, because, I had a messed up childhood, so I was already relatively self-aware. But it's just worth having a talk with yourself and be like, hey, this is impacting the actions. So you have to stop making decisions based on X, Y, and Z and start letting the chart make the decisions and start letting objective reasons make decisions. Yeah, exactly what Master said, just getting the I out of it. That doesn't mean you have to go away. It just means that you have to recognize that the market's always going to be right, and you're not. So there are a couple fundamental truths about the market, okay? The first is that there needs to be understanding. And when I say that, I mean you, as a trader, need to understand your role. So if, for example, I'm looking at FCUV, okay, and I understand that every single transaction requires one buyer and one seller, and price moves as a result of people agreeing that transactions occur at one specific price and then another and then another, I need to go where those potential negotiations are. Okay? That's the only way price moves. That's a market mechanic fundamental concept. Okay? So in this case, I can see that there are negotiations waiting here and there are negotiations waiting here. That's a setup. It tells me the potential. So if I can get over 1350, for example, and you guys watch me do this all morning before this, obviously I'm doing this for demonstration. If I can get over 1350, I can tell that there is potential here for maybe some more moves, but only if the volume comes in and actually makes those transactions happen. So until that happens, I'm hands off. I don't touch. Right? What gives you the most percent per year? You mean in terms of my overall net worth? I do private lending. Just fat interest on private lending. Aggregate interest, not per customer. Now, I also make a bunch in dividends, which I don't want. I don't want a bunch of dividend income because that's higher taxes. So therefore, I have to sell. So here's how it works. Let me just break it down for you. Probably be easier. All right. So we've got big fat portfolio, right? Or other collection of assets. Then we go to specialized lender, get S block. Okay. Let's say we do... I'm trying to think of some reasonable numbers here to work with that can be relatable. All right, so let's say 3% interest, and we've got a 150K draw, right? Let's just say that's all we use for the year. Okay, obviously the limit would be much higher, but for utilization ratio for credit and stuff, we don't want to go over like 5 or 10%, right? We really want to make sure that we're responsible with it. Either way, we're going to make sure that we understand exactly what we would owe, and we have to understand also that we keep these, right? We keep the assets, okay? And all we're doing is we're going to the lender and saying, hey, I have all these assets, it's worth this much, loan me some money, I'll give you a good interest rate on it, and if I default, you get to sell off whatever you need to cover the loan, right? That's all it is. And in exchange for borrowing that cash and having that flexibility, you pay an interest rate. Then if you have immaculate credit, you get a nice low rate like 3%, everybody's happy, right? So let's say I borrow $150K out of this line of credit with a much higher threshold, so I keep my LTV nice and low. Then this also produces dividends and growth. Okay, so let's say this makes just a lower number. Let's say we make like 120K, right, on divs, and then of course the shares continue to grow as well, right? We just make a 0 here. That makes sense. Did a little curly Q on that. So let's say I make 120K in dividends. I owe taxes on that, right? There's qualified, there's ordinary. So let's just assume that we owe, I'm just trying to do some quick math here in my head. Let's do 30K. 30K taxes. So now I need to figure out how I can reduce any of this stuff, right? I know that I can reduce the 30K in taxes by selling for tax loss harvesting, right? I could take 30K in losses. That will balance out 30K worth of the 120K, but I can't use any more than 3K, so I really should be selling down 120K, right? Because I want to bring that number to 0 or as close to 0 as I can while still reinvesting, right? So I'm shuffling things around. So I sell the underperforming stuff for losses or stuff that doesn't pay very well, and then I shuffle that back over into the more stable things. And this is primarily where hedges come from. So if I'm hedging a large portfolio and I buy a put and the value goes up, the put loses value, that's part of the capital losses, right? So I'm just insuring against my dividend payments at that point. And if things go lower, then I can sell those and so on and so forth. And if the overall value goes down, the put value goes up and it stays flat, right? So really just offsetting these taxes is the biggest obstacle. And there's a ton of ways to do that. I mean, I'm talking outside the market, in the market, it's very doable. Now, the problem here is I owe 3% on this 150K plus the principal because I want to get that paid off as well. So I could very easily make more than 120K in dividends, but I've got these mostly shuffled over into growth stocks so that I don't have to have that burden. So I need to figure out what I'm going to do to offset this 150K. And I've got a couple choices here. I could just keep the 120K and pay taxes on that, which would be about 30K, or I can sell 120K down, roll the 150K over, and pay 3% on top of that, which could very easily be covered by the 90K that I keep on the dividend side. So let's do that, right? Let's walk through that. So 90K free cash, effectively, from dividends, okay? Off of the 150K plus 3%, which would be, just bring out a number there, 4,500, so 154, 500. Okay, so that's the amount that I would theoretically have to pay to get back to break even for that year, right? Now I subtract 90K, that brings me down to, let me just do some math there, that's 64.5K. So instead of, I get 150K that I get to use, right? But I owe taxes, or I owe APR on it. I don't pay taxes on the 150K. I do pay taxes on the 120K. So because the 120K is smaller, in this case, I would only keep about 90K of it, and that would reduce this payment to 64.5K. And if I've got a much larger portfolio, and I get a much higher line, and I'm only using 5 to 10% per year, and then I'm cutting that down into almost a third, to where I'm only using maybe 2%, I can keep that going for decades, before I have to roll the loan over into a new S block with a different lender. And then I can also, sneaky deaky here, I could take out a life insurance policy and use the collateral to pay off the loan so that I can transfer the wealth to next of kin. And then some, right? So this is how wealthy people just live on debt. There's no tax burden there unless you buy stuff. I should do a prop firm challenge. Maybe one day. I'll be hating on it the whole time. This is what I'm saying though. Once you get out of the grind, quote unquote, which is where I don't want anyone to start, there's another strategy here, and it's all just wealth management. You're focusing on money flow rather than just candles going up and down, right? But that's where most traders start. That's where most traders stay. They don't have a plan for what to do with the profits. So if you just buy and sell and maybe you're profitable, maybe you're not, you still have taxes. You still got to figure that out, and that's okay. But if you grow an account large enough and you're not trimming it, right? You guys are going to recognize this, right? If you're not trimming a portfolio regularly, you're going to have a very hard time keeping those numbers in check. Right? So I'm going to walk through this really quick because you guys are all very familiar with it already. And then I've got this, which is the total account value, right? So let's say I bring $100 up to 150, right? Which I can do in a day or two. And then I trim that 50 out, right? $50, boom, locked in. It's cash. It goes right up into here. $50, okay? And then I do that 2 more times. So that's 150 that I didn't have before, right? Started with 100. Now I have an extra 150 sitting over in the investment side, okay? Then I bring the 150 up to 250. So the last time I bring it up to 150, instead of trimming it, I let it grow if I can, if I have, psychological obstacles getting in the way, or if I lose discipline, I'll just do this more and more until I'm comfortable sitting at 150 and letting it go higher. Then I bring 150 to 200, trim the 100, trim the 100, trim the 100, that's 300. So now I've got 450 in here. I started with 100, right? Then let's say I want to bring the 250 up to 450. Right? There's another 200, another 200, another 200. That's 600. Put that up here. Okay? Then I want to bring the 450 up to 700. Okay, that's 250 there, 250 there, 250 there. So that's another 750. Okay? And then, of course, go up to 1,000 after that. And so on and so forth. Like, you guys get the idea, right? We're just gradually increasing, and we're trimming those profits as they're there so that we don't give them back to the market when the number gets bigger faster than we expect and we can't handle it and we take big risks. So rather than doing all that, let's just trim it consistently and then just put it into a pool, and then the pool can build assets, and then we can get closer and closer and closer to building that end goal of getting an S block and then taking out life insurance against that. So in this case, we'd have 1050 plus 750 is 1800. And we started with 100. Okay? So we would have 19x'd our money just by trimming reliably, locking in base hits, managing losses, and keeping the portfolios in a responsible range for a progressively higher series of ranges. Does that make sense? And that's also why I don't like people saying, I need to start with, so much money. I need this. I need that. You don't need anything in the market. I would say maybe don't go below like $20 because then you're just going to put in a bunch more work, but you don't need a bunch of money to start. You can grow any amount that's reasonable into any amount. So if you start with $100 and you can grow that up and buy a house with it, you would have bought a house effectively for $100 and some effort. Who can make the most profitable scam firm? A guy who trades prop firms just for his credit card bills. And you can get, even if you take the best profitable, the best prop firm, right? You're still losing money that you've earned. Like if I loan, let's say I loan Master $50,000 today, right? But I get to keep 30% of what he makes. And then he's got to pay taxes on all that, on the amount that he makes. Why the hell would he do that? It's just it's the allure of having access to more money so you can get bigger payouts sooner. But at the end of the day, you're still paying to trade someone else's money, and you're just short-circuiting time. And I get it, if you can, that's great. But why not just also do it for yourself, at that point? Are you taking the money that you're making from this prop firm and compounding it so that you can then not use the prop firm? Because I'll tell you right now, they don't make money. They don't make more money from your trading and their portion of your trading. They make most of their money on fees. I guarantee it. I think people don't believe. Yeah, exactly. You start with $20. Here, let me find that screen share. I just put it in the chat earlier. Because obviously if you're coming into this, you're going to see that I'm 40% down. That's because I was showing something. But here, this is where I stopped trading earlier today on the premium stream. 31.11% up on $100. I just trimmed it down after I basically doubled it yesterday. And I got it up 30% again, right in front of you guys. And then took this demonstration here to prove that, this is the kind of thing we open ourselves to if we don't follow rules or if we don't have a plan. So don't do what I do on this account, because I'm demonstrating stuff for you guys. But the small amounts, you can compound them really fast. I know a lot of people, they don't want to quote unquote work for pennies, but at the end of the day, it's all about percent ROI on dollars invested. So if you can grow $100, if you can grow $20, you can grow $50,000. But you don't need to take a risk or pay someone else to use that kind of money if it's gonna come at a cost. And more importantly, if you can't do that and you're gonna lose, why would you do that on your life savings? Why not just start with $20 and use that to purchase your education from the market and use the information that it gives you deliberately, instead of just saying, oh, this went down, that went up, this went down, that went down. And then not getting value from it because you don't know what to look for or how to frame things. You're just wasting your time, but at least you're saving money by not committing a whole bunch of money. But you're going to tell yourself you need more money to be successful and get it turned around and do better, when in reality, you're just going to do the same thing. You're just going to lose more. So I would love to see everybody start with very small amounts of money, especially if you're day trading. This is not a predictive process. You don't want to try to figure out if the price is going to go up or down. You just have to accept that it's going to, and that you don't control that. You control whether or not your money is in a fixed state where it doesn't change value, or if it's a dynamic state where it changes value until you stop that from happening. Okay. Just put everything into SB. Yeah. And that's the safe route. And that's what, you would do with larger amounts of money, is you just put it into things that are stable. And the S&P is not bulletproof as well. If you look at the SPY and you go to the monthly, there are red months on SPY, contrary to popular belief. And some of the ranges on SPY are significant. This is back in 2025, last April. It lost 16.5% of its value over a 1 month period. So overall, yeah, it goes up, but you've also got some serious pullbacks on it. And some of those pullbacks can prolong, like the 2008 crisis, for example. That's a pullback. It's not a crash. I know a lot of people called it a crash. It's a double bottom, basically, or triple bottom. That's not a crash. That was just a pullback. So, just buying and holding S&P, it can work. There is value in it, but if you're not properly diversified both in the market and out of the market, and you're not able to compound things, you're going to struggle. Right off, my goal is to get $100. I never got $100. What do you think recommend me to do? Well, first off, I would encourage you to go slow. It's very tempting to put money at risk because we have money in our pocket and we want to make things happen. But until you're able to justify converting your money into a dynamic state where it is subject to losses, I would consider quality learning. And by quality learning, I don't mean strategy hopping. I don't mean spending hours, days, weeks, months, years back testing technical analysis strategies. I mean, learn yourself. And by that, I mean do something very simple. So I'm going to go with the 1 minute here. I'm going to teach you guys the box drill just because this is where we can start getting value from ourselves. So what I would like to do, okay, are the analysts here financial advisors? No, I will never get SIE. I will never get Series 63, 7, or 65 because that puts way too much restrictions on what we can talk about. And yeah, I'm just never going to do that. So for the box drill, okay, the purpose of this is not to, I'm going to log out just so you guys, no dollar amounts are involved here, right? I'm not caring about whether or not the price goes up or down. I don't care about what happens after it leaves the box. I'm only interested in zooming in very, very close to whatever candle is previously closed. So I'm going to draw this ahead of time because the candle's going to close here in 2 seconds. And all I'm going to do is keep my brain as empty as possible. And I'm going to watch this chart. And every time the price pushes above the box, I push a 1 immediately on my numpad. If the price pushes below the box, I push a 2 immediately. If it does one of these numbers and it does it 3 times, I hit 2 3 times. Does that make sense? I'm going to do that until I get 5 numbers. Doesn't matter what order they're in. It doesn't matter if the price breaks out and doesn't come back. Obviously, if the price displaces aggressively, then I'll just stop the drill right there. But the idea here is just do this 5 to 10 times without thinking. You don't want to think. You don't want to police your thoughts. You don't want to have expectations. Just keep your brain as empty as possible, because after the 5 or 10 times, then you're going to reflect. Because everything that comes into your brain before the end of the drill is your brain trying to tell you something about a risk. It's a risk perception response. Okay? And that's an insight into the state that your brain goes into when there's a risk perception. So right here, for example, now I'm talking and I'm kind of slowing down here. So I'm just moving the box here. So for example, it broke out of the box. I would have pushed a 1 if I wasn't moving the thing. But I'm demonstrating this, so give me some slack here. So if the price dips into the box and then pulls back out, I push a 1. And don't beat yourself up if you don't do it immediately. Just try to do it the best you can without thinking. All right, boom, there's a 1. Boom, there's a 1. Oh, see, I pushed that one a little early, right? Didn't really break out of the box. Boom, there's a 1. Right? So I'm not thinking. Obviously, I'm talking, so I'm kind of, there we go. So 5 right there, right? That's it. That's the work that we put in. I pushed 1 5 times. All right. Now, were there any expectations about where the price would go or what pattern we were looking for, or a setup, or were we looking at volume or any of that stuff? The answer is no. I was just looking for one specific line to be crossed by one specific shape. And then, more importantly, the direct communication between the parts of my brain that says, hey, I see this, I push this, then that's what we need to hone in on. So what kinds of things would our brain throw at us in that moment, right? There's always that what if, you know? So a lot of times, now fortunately this candle's red and we tend to see it more on bullish candles. When bullish candles break out, the brain may have some anxiety because right here, for example, this is a big red candle. Our brain's gonna go to the hippocampus and say, hey, do we remember this? It's gonna ask the amygdala, hey, did we have a previous feeling about seeing a big red candle? And they're both gonna say, yeah, it was miserable and I hated it. Therefore, get it away from me. And that causes the amygdala to flare up and try to protect us. Now, in this case, we're not concerned at all with the outcome. There's no risk here. It's just seeing a big red candle. In this case, it's seeing a breakout or a breakout to the downside. So when we're doing our button pressing, we're taking the process of our brain that says, hey, let's freak out about this, and we're converting it into an action instead. So it's a form of exposure therapy because most traders have been traumatized by large red candles or similarly by large bullish candles followed by large red candles. So we're just bringing things to the surface in our brain by just pushing 1 or 2 when a very simple condition is met, and then we're reflecting on what our brain was talking about during that whole process. Does that make sense to everybody? In the server, are there investments posted by analysts that they will hold, not financial advice? What do you mean, like a disclosure area? I don't currently have any swing trades myself. Lee and Bull post theirs. We do the Playmaker trades. So as far as I know, yeah, everything that I trade is posted. Investments to hold. Well, we got the rest to retire. That I think he has a spreadsheet for. We also have the archive of all the old reports. It's a newsletter, basically. It's a three times per month newsletter. Lee dives deep into these companies. There's a lot of fundamental analysis and a lot of, like he tells you where the key levels and stuff like that are. And there's a chat channel where they can discuss them. All right, Master, take care of yourself, man. It's glad you to hang out with us today. Thank you, as always. Enjoy your weekend if I don't see you at the wrap-up. What are the returns like? Last I knew, I think there was like I want to say a 54% ROI within the year, but I haven't personally audited that in a while. I'm pretty sure he still has a spreadsheet. So if it's on there, you're free to check that out or ask him. I don't have access to that stuff right now. You're just looking for buy and hold investments? I could tell you what I'd look for. Okay. We only have to answer 3 questions. So how about I just teach you how to do it, and then we can look at some examples if you want, and then you don't have to rely on anyone else. Sound fair? No, you got to give me 30% of what... No, I'm just kidding. All right. So let's look at those 3 questions. Let me just get this over here real quick to make sure I don't pull up anything sensitive. So we have like one-on-one calls, and sometimes I have personal information on there for members. All right. So when we're looking at investments, we have to look at 3 things. Is the company making money? Okay. Is the company keeping money? Is the company sharing money? All right. I'm a shark. Yeah, I try. So in order to see if a company's making money, they only make money a couple different ways. So one of the biggest things we can look for is revenue, right? I'm going to just give you a crash course here because I do have to get off soon. Plus, I teach a lot more of this stuff elsewhere. So revenue. Are they keeping money, right? Then we look at free cash flow. Okay, we say after all their expenses, what's their take-home amount of cash that they put in their pocket at the end of the day, and that's free cash flow. So if, for example, you were to start a hot dog truck and you want to sell hot dogs and sodas, you'd have to buy the truck, you'd have to buy the license, the permits, all the gas and insurance, and you'd have to buy the actual hot dogs themselves, the buns, the condiments, the Pepsi. You'd have to pay taxes on stuff, so on and so forth. You'd have some expenses, right? And if you hire someone else to run the hot dog truck, you got to pay wages. So if you sell more than you spend and you make more money, you get a positive free cash flow. Okay. And then is the company sharing money? Do they have a history of heavy debt? Do they prioritize preserving dividends, or they take money out of dividends when they have to cover expenses? What's the growth look like? Is it an income dividend position or a growth dividend position? So let's look at an example. Do you have a ticker? Microsoft. All right, let's look at Microsoft. So let me pull up Microsoft here on FinViz. I'm only going to look at one thing here, and that is this right now, current ratio. It's above 1, right? This is just an immediate sniff test, so I can say, hey, the current ratio is basically their, okay, let's start fresh. Okay, total current assets. This is everything they have on hand that they could sell if they need to raise money, right? That's short-term liquidatable assets. Total current liabilities are their 1 year scheduled debt. This is things like mortgage, property payments, equipment maintenance, insurance policies, payroll, taxes, outstanding debt obligations, payments on line of credit, things like that, right? So it's their scheduled debt. The ratio between these two, if I were to divide this one by that one and convert it to a number, it would be above 1 or below 1, meaning that if they had to close the doors today, they could capitalize on these assets and sell them all if they had to, and cover their next year's worth of scheduled debt, right? So in theory, the current ratio right here says that if they close the doors today, they could survive 1.23 years just based on what they have on hand to sell. Does that make sense? So it's above 1. That's good enough for me. All right. Now, let's pull them up on stock analysis. This is where we answer our 3 questions, right? I'm just going to go to financials. They added this new tab, by the way. I hate it. I just click on income statement. Now, revenue. Is it a positive growth? Are they making money? And is that money growing? The answer is yes. It's a nice little curve there. The plateau is good. Curve is nice. Downslope, not so good, right? So this checks out. I like that so far. Now, are they keeping money? What's their free cash flow look like? So we scroll down. Free cash flow. That's positive. That's good. That means that they're consistently able to keep above 55 billion or 59 billion for the last 5 years in a row. That's good. They're keeping money. That's awesome. Answers the second question. Are they sharing money? Right? So I'm going to look at the dividend, and if it's below 3%, that tells me it's a growth position. If it's 3% or above, it's an income position. So let me click the word dividends, and I can see it's a 0.79% dividend yield, which means this is not an income position, which means this is a long-term buy and hold with the intention of getting share growth. Okay? If it was above 3% or something like that, then I would look for that more of a cash cow that I could just reinvest the cash from over and over and over. So for a long-term stable dividend portfolio where I want the shares to grow and I don't want a whole bunch of dividend income because I got to pay taxes on that, this is perfect. I like Microsoft. Now, I got one more step. Got to look at the SEC filings. Okay, Microsoft. Let's first look for the deal breaker. Do I see an NT10Q? The answer is no. The reason I don't want to see an NT10Q is because 10Qs are the quarterly earnings reports, and those are done completely internally. So the company doesn't have to send those off to an auditor. They don't have to do a whole bunch of other stuff. The 10Ks or the yearly ones do. So it's okay to see a delayed 10K filing, but if I see an NT10Q, that just means the company couldn't get their stuff together and file their own paperwork on time. That's a huge red flag. So I don't see any here. Now let's look at 8Ks for potential catalysts. I also get a phone call there, sorry. All right, so in here, I don't want to see a 1 dot anything, and I don't want to see a 5 dot anything other than 0.02. So 2.02s are just earnings, 9.01 are just attachments, 8.01s are press releases basically, 7.01s are just extra disclosures. So I'll look at these, but I'm not going to look at these, I'm not going to look at these, I'm not going to look at that or that or that or that. This is a shareholder vote thing, their annual votes. You can look at the results for that one. 7.01s are always kind of good to look at. This is always a red flag. Amendments to Articles of Incorporation. This is kind of the rule set that the company agreed to when they became a company. So every time they amend that, they can do things like take away shareholder rights. They can do all kinds of stuff. So I don't like seeing that, but it's worth looking into. It's from last year. So this is the first 8K. This is the departure of directors. Don't really care about that. I do care about this vote. So this is the results of a vote because there's numbers. These are the items they were voting for. And I only have to care about the ones that passed. So I want to see, is there anything else? Okay. So basically this little column right here, this percent votes for, if it's above 50, that means it passed. Or if you see approved here, that means it passed. So approve, okay. Executive compensation, don't care about that. Appointment of independent auditor, that's common, don't care about that. Microsoft Corp 2026 stock plan, that's employee reimbursement or employee compensation. That's a good thing in my opinion because they have all that free cash. European Security Program censorship risk audit. I'd have to look and see what that's about, but it's not approved anyway. Not approved, not approved, not approved, not approved. So I don't care about all these. All right, so no real deal breakers there. Gonna close that, and then I got to look for this 7.01 on October 2025. Okay, they posted a blog, so and they put out an investor presentation, so they're on top with publishing things. So I like this. So I like Microsoft as an investment. Now I got to look at my portfolio, right? Because I got those 10 blocks to fill. Where is it going to fit? Do I need a tech stock? Do I need a company that is a growth position, or am I just looking for an income position at this point? What other stuff do I have in my portfolio? Would I buy Microsoft and the Qs? Probably not. So on and so forth, right? And then my allocations. Does my current allocation allow me to buy one share? Or would it sit cash for a while and accumulate and then buy a share? How many contributions would I need to keep in cash form, which is okay, right? Because we still get the 3.5% on that for settled cash on broker interest. And then how much would I need to contribute in order to be able to participate in Microsoft? Oh, I forgot to read about the amendment. Okay. Okay, not a big deal, in my opinion. So, so far so good. I like Microsoft. Now it just boils down to whether or not it fits my portfolio. Does that make sense? So let's do another one really quick. Somebody else give me a company right now. I'll whip through it just to show you guys how fast the initial screening can be. Google. All right. GOGL. We like it. All right. Current ratio. 2.72. That passes the sniff test. Let's go over here. Financials. Let's look at the income statement. Revenue. Growing. I like it. Free cash flow. Above 50 billion. I like it. That's good. Balance sheet. Let's see there. Total assets, total liabilities. That's positive by 1 to 3. That's good. I like it. Are they giving me money? Low yield. That's good for an investment. Shares of $354. I like it. I like it. I like it. I like it. Dividend yield has decreased over time, which may be a red flag, but this isn't an income position, so it's not a big deal. They're making plenty of money, and we're good. So let's come over here. Let's look for upcoming catalysts. We'll look for the NT10K, or NT10Q, sorry. Don't see that. Let's look at the 8Ks. All right, I got a 5.07 there. I got a 1.01, so entering into an MDA. That's usually some sort of collateralized debt agreement. Material modification of rights of security holders. That's important to look at. Here's another MDA. A couple of 801s. These are good for like looking at dates where volume may come in. I'm not going to go through all that now, but that would be part of the deeper research that you do. But these are all the way back in February as well. Basically, you'd just be looking for future dates. All right, so let's look at this one. Okay, so we got a bunch of that. Mandatory convertible preferred stock offering. Okay, so June 2nd, blah, 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 blah. Okay, so basically they're issuing Series A depository shares. It's not a big deal for us. That's more on the preferred side, so we are good. I don't see a dollar amount. Where's the dollar amount? $1,000 per share. Okay. Sorry, I'm just trying to skim through this really quick. Don't really see anything negative about that. Cap call transactions, okay. Again, don't really have to worry too much about that because that's related to the offering. And if you have questions, like a lot of the stuff can read really dry and complicated. If you have questions about these SEC filings, just ask Lee or I. I mean, we're in these all the time. But you don't have to like learn everything to understand them. And then there's a AOI amendment. Okay, I'm not reading through all that. These are just the attachments. Okay, I'm just kind of looking for some red flags here, and I don't really see too many. That's more up to $40 billion of shares. Give me one moment, guys. Okay, sorry about that. I'm back. Just had a question from the old lady. Why would like Google with a 0.25% yield? Because I don't want to pay taxes. So it's a growth position. You want the share growth. So if I come back over here and you look at Google, or sorry, in here, I actually have to click the thing. You go to the monthly. I'm really just looking for this trajectory to continue. But that means that it's in the collateral bucket, meaning that I want to get as many of these as possible over time so that when it's time to bring this portfolio to a specialized lender and ask for a good line of credit at a good rate, I need a good credit score and I need a big fat number of stable stocks. And then they will use that value and loan money that I can use tax-free. I can draw against the line of credit. So that, but I don't want to amass a bunch and then also have a bunch of dividends that I have to pay money on. So that goes back to like way earlier in the stream. I don't know if you're here for that. This is recorded though, so you'll have a copy of that. But it's a strategic thing. So you want a good mix of income and growth positions. But if you just have income positions, you're going to pay more on those dividends. So that means you have to also probably sell more to reduce your taxable income. And then if you're also reinvesting those shares, then the goal is to do that so you get those shares for free, effectively, because you're getting the money and you can reinvest the money, but then you have to offset the act of getting that money by selling other stuff. So it's a little bit of a roundabout way to just manipulate your money flow. But the goal is not to just get a whole bunch of cash because then the government wants to take bigger chunks. All right, good stuff. So here's another MDA. This is, again, it's the same one I was just looking at. All right, here's the FD press releases. Okay, don't care about that. And then here's just a description of the depository share offering. That was earlier this month anyway. Okay, so yeah, I don't really see anything substantial there as a red flag. So yeah, I mean, this one goes right in the same bucket as Microsoft. Now, again, the question, do we want Microsoft or Google, or do we want both? And that is all about your portfolio structure, because there are two large tech companies. So if you just want to build a portfolio based on tech, you could, but then if tech takes a hit, guess who's going to pay? So if you had nothing but like the Qs, Microsoft, NVIDIA, like just the big, the Mag 7, for example, and then some ETFs that are also based on tech, if tech takes a hit, you're toast. You're going to lose a bunch of money, or at least you'll have a bunch of drawdown, right? And if you're in the S block territory, you don't want a lot of drawdown because you want stability so that the lender doesn't freak out and be like, oh, I don't know if I'm going to have enough to sell this to cover your debt, but you do. And that's, you don't lose everything, by the way. If you default on an S block, you just have, you're giving them the right to basically liquidate enough to cover any obligation you may have. So if you have, like, let's say 15 million, you don't lose all 15 million. You just, like, if you have a 20K draw, for example, you're just authorizing them to liquidate you by that 20K. So it's not the end of the world. That's one of the questions I get a bunch. All right. So with all that said, I do have to jump off of here. Does anyone have any questions before I go? I'll upload the recording as always, and I'll put it in the Rags to Riches team chat channel, and I'll pin it. But I want to make sure everyone here has a clear understanding of A, how the market works, B, the role of you in the market, and C, just some basic portfolio structuring techniques and kind of the reason why we do stuff. So we want to be financially secure outside the market. We want to make consistent contributions. We want to put most of those contributions into passive income. We want to use very small, very well-managed allocations for speculative trades, and then compound those profits by trimming them into passive income. That way the numbers stay in a familiar range, so you can execute consistently. You can expand your tolerance for that range over time, and the numbers will get bigger and bigger, but you're not taking unhealthy risks trying to get there faster. And then the goal is to amass a large portfolio of assets so that you can qualify for things like S blocks and live on tax-free debt instead of continuing to grind and continuing to pay the government 35% of what you make. Or 10% if it's long-term holdings. Look at technical and fundamental analysis while picking long-term stock. I almost never look at technical stuff when I'm looking at a stock for a long-term investment. I very rarely look at the chart. I might choose whether or not I want to kind of ease into something, but most of the time I don't. Now, it depends, obviously, because if it's like a biotech company, you have to look at their pipeline because that's going to bring volume because those are catalysts. Do I invest monthly? Yeah, I make consistent contributions from other areas. But I also don't go balls to the wall and put all my money into the market because I have other forms of investment. Yeah, I still contribute here and there. I'm not putting it all in this account because I would much rather just use a small account here to demonstrate stuff for you guys. And to prove that you don't need a bunch of money to start. I get so many DMs asking how much money I need. Like how much do I need to start trading? The answer is like $20. Like you don't need any risk to learn. And when you start trading, you don't need a big number. I would much rather see everyone start with small numbers because you're going to take the hits. And it's all about learning how you respond to those hits. So it makes no sense to put most of what you have into a chart that you don't really understand but have a ton of confidence about, and then just keeping your money in that dynamic state. That's just not healthy. I'd much rather see the bulk of that money go into passive income and then using a very small amount, like 20 or $50, to figure out the speculative stuff and then just grow that seed. Protect it, nourish it. It's yours. So if you want to do a challenge, I would challenge you to start with a very small amount of money and just grow it. You can literally buy a house for $20. I'm not saying everyone's going to be able to do that, this year, but everybody is definitely capable. Is discretion a big part of your trading strategies, or are you more of a mechanical trader? If you're talking about speculation, it's all mechanical. Because I understand that in order for certain things to happen, other things must happen first. And that's what I rely on. There are 3 layers of abstraction behind why I don't trust technical analysis. As someone who's learned damn near all of it to an excruciating degree, I promise. People lean way too heavily on charts. Oh, yeah, no, Vinny. So basically, I'll give you a really quick one, and then, just watch the video for the more in-depth explanation. Basically, if we amass a large portfolio of assets, bring it to a lender, and then take out a collateralized loan against those assets, debt is tax-free. So instead of paying 30 to 35% and keeping all that money at risk, we get to keep the assets, and we also get to live on the money that we draw from that line of credit, and we pay a much lower interest rate, like 3%. So I walked through an example of it too in the video, so you can see it. Yeah, anytime. In terms of day trading, what do I look at other than technical analysis or just that? I traded live this morning on premium and I didn't even use a chart. I think I pulled up the order book like this and just traded it. I don't need a chart. And I've been screaming that from the hilltops for the past 2 months. It's not to say that technical analysis doesn't have a role, because I believe it does, and I believe it's a very important role. But I think people misuse it because they misunderstand it. If I'm looking at a chart as a trader, I should only be looking at it in the view of how can I protect my opportunity that I take. So if, for example, right, I've got cash and I want to put some of that cash into a dynamic state where it can change value, I'm going to transform some of that cash into shares. In order to do that, I need to understand where I'm going to cut that off and where I'm going to turn those shares back into cash so that value stops changing. Now, in this case, because this is a price time axis chart, there are 3 conditions that I need to factor. Okay? there is, let's say I buy it right here, right now, for example, okay? The price will go up, down, or sideways from this point inevitably, right? So I just need to figure out how far am I willing to allow my dollars to go down and how far am I willing to allow my dollars to go up? And how far am I willing to let those dollars remain at risk in the future as well? And that's something that we tend to ignore, and that's why you see people turn day trades into swing trades, and then they're down 80% the next day and don't know how they got there, right? So in this case, if I were using technical analysis in the form of indicators or candle analysis, I would probably choose a local low. And I would say, all right, well, if the price fills at 353.25, I would get out. What's going on, Michael? Am I more of a fixed RR targeting your draw or reactive? Oh, well, I'm just saying, if you're using technical analysis to try to predict whether or not the price will go up, you're going to hurt yourself. Technical analysis is all about identifying your risk versus potential. So in this case, I see a valley here. There's nothing that tells me the price has any indication of going up. So the only thing that's going to tell me the price is going up is when the price actually starts going up. And therefore, this is irrelevant. So I don't even need the order book, right? Just logically speaking, I'm going to flip a coin. Like I let you guys do this all the time back in the day. You pick a ticker, you pick a time, you pick a price, I draw a line, and then we back test it, and we come out with a net positive end result most of the time over a series of trades. That was the little parlor trick, right? And that's all trading really boils down to. So again, if you're using technical analysis, just use it the right way, and I will support you fully. If you're using it to say, I'm going to get out here, I'm going to get out here, up or down, they're both the same action. You're taking risk off the table. You're converting shares back into a fixed state, which is cash, so that the value doesn't continue to change. And ideally, your profits are larger than your losses, but at the end of the day, it's the same action. So if technical analysis can help you identify specific areas where you're willing to push the button, and then you're actually able to push the button, great. But if you're using it with the intention of the price going from this level up to this level, you're going to hurt yourself. Because it's not a predictive process. Nobody in the market is good at predicting. I don't care what anybody says. You cannot predict the price in the market. But you can understand how the market works, and you can understand the mechanics and identify potential, and then you can match the incoming volume with that potential, which is why I look at the order book, and I teach that. Because in order for the price to move up, there must be agreements at higher price points, and we have to understand that if that's going to happen in bulk, we need an area where that's concentrated, right? So yes and no. Like I do agree that technical analysis has a role, but I don't think it's the role that people assign to it. And you can add all the indicators, you can add trend bias, and you can convince yourself that all those sophisticated rules are going to have an impact on the end result, but they don't. If bottoms were respected, you wouldn't have lower lows. If highs were respected as targets, you wouldn't have higher highs. If higher highs and higher lows in sequence were uptrends, you wouldn't have breaks of trend. You wouldn't have harami candles or engulfing candles if other conditions weren't met, right? So rather than trying to predict or set these rules up for ourselves that we sometimes follow, sometimes don't follow, pick one rule, make it simple, and then see how you respond to actually following it in real time. And then consider putting money behind that after you've developed the ability to follow that rule, not before, and you'll have a better time. Do I think a 1-to-1 risk-reward ratio is bad? No, not necessarily. There's a couple ways we can break that down. So if, for example, okay, let's say that we've got I talk about phase 1, 2, and 3, so let's do that really quick. So we got 3 phases of trader, okay? First trader, phase 1, this is where I'd love everyone to start. We've got a 1 to N risk-reward ratio. So let's say this is R, meaning entry to stop loss, and then this is N to R. Okay, meaning it's a multiple of that risk range. So in your case, you're asking about a 1-to-1, which I don't think is bad. As long as you're catching price as it's moving the direction that makes you money, and as long as you have confirmation that it's ask dominant volume, I don't think that's bad at all. as long as the 1 in that case isn't like a 20% or 50% range. Now, this is basically where most traders start, especially when it comes to like signals, right? Because we get in here, price kind of does one of these, we hit our target, and that's it. That's the end of the trade. Or the price goes down, and then we stop right there, right? So we're 1 buy, 1 sell. This is 1 buy, 1 sell. Okay. Then we've got the scalability, right? So in this case, let's say we've got a trade. It goes 1 to 1 or 1 to 3, whatever our risk reward ratio is. Boom, 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 right? We capture here. This trader would end the trade, and that's fine. This trader would end the trade there. They'd have the same end result in these two universes, but this one would have a decision to make, okay? If I lock some of these profits here, like 75%, okay, the price may turn back down and go against me, in which case I make less profit than here, okay? However, if the price continues higher, then that 25% that remains increases the profit and I make more money here. Does that make sense? So if I'm using a 1-to-1 and I'm locking that base hit consistently, it all kind of boils down to whether or not I'm able to hit that 1-to-1 consistently. The target. I don't think there's anything wrong with just getting 1%, 1.5% profits on every trade you take. I love that, especially with the PDT rule change. Those are the kind of base hits that can really compound stupidly if you do it right. The challenge there is slippage because it's such a small range. So you got to be careful with that. Now, phase 3 is a little bit more complicated. I'm not going to get into all that right now. But basically, this is where we add to and roll an average up, and that's more of an advanced strategy. So we put exploratory 20% here, then we put 80% larger commitment here. We lock that 80% right there, and then we add another 80% here, and that pushes the cost basis up, the average. And then what we do there is just put the stop loss right above the cost basis. So after that first commitment, you're really no longer at risk of losing money on that. And that's more of an institutional strategy. But on a smaller account, you're going to get diminishing returns on that. So that's why I don't encourage that until you're later on. So this is 1 buy 1 sell. This is 1 buy many sells. And this is many buys, many sells. And these are the progressions that traders inevitably walk through across their journey. Does that make sense? You do a fixed 1-to-1 risk reward ratio on prop firms because they reward low variance, but what would stop me from trading a live account? Time to time, my ego gets to me after a few payouts on the same funded. There's nothing stopping you from trading a live account. I would love to see it. I also have a strong distaste for prop firms. I think that they're just not a good instrument for most people. But if you have a good experience with them and you're comfortable paying more for the same effort, you're more than welcome to. I just would also like to see you develop confidence and just grow a small amount into a large amount. It doesn't have to be complicated. So let's look at MGRX, for example. Right? To the moon or nothing. Definitely to lock out on a live account. Well, it depends on what kind of trading you're doing. I mean, like I said, we as humans, right, we're avoidant creatures. So we run away from situations which don't allow us to have control. Because that lack of control creates uncertainty, and the brain responds to a very specific way in the form of stress and impulse, right? We resolve stress with impulse in our brain. We want the end result. We want it now. We want to be out from underneath that uncertainty. So we tend to make things more complicated because we need that control, okay? And in doing so, we're building rules for ourselves. We're building plans for ourselves. We're making things complicated and sophisticated because it feels like we have control. And all we're doing is avoiding accepting the truth in that we don't have control over a lot of the stuff. We don't know if the price is going to go up or down. We don't control that. We can place an educated guess on where it has more or less potential, but we don't actually control the outcome, which causes us to hesitate in the moment when it goes against us. And it also causes us to short circuit our profits early and try to predict things and try to pick the bottom and pick the top, and it just doesn't work. And then we get even more stressed out, and we just get all this chaos and confusion in our brain at that point. It just makes things spiral. You saw it goes up. Fair enough. Epic, I think once you figure it out, you're going to be a powerhouse, dude. Because you're like the other 3 people in this Discord that have all started off the same way. And you guys, like, they're crushing it right now. Like Farouk, for example. Dude's a beast. So when you're done selling yourself short there, I got you. Let's make it boring. Yeah, it really doesn't have to be complicated. We just have to understand how the market works and just go with the flow, literally. And, if something goes against you, like this one right here, for example, FMFC, I have no idea what's going to happen. I don't see anything more than you guys do. I just see that there's liquidity waiting right here. The price may or may not get there. So I know that around 97 cents, there may be something worth watching here. I know that above $1.16, there's a small hill starting, but I'd have to see where it goes. So I'd be looking at this above 97, 98 cents. This flat area here, I'm not touching. Because if you get a surge in volume anywhere in here, it's going to move the price very violently, and you don't know which way it's going to go. I know that here, certain things need to align. I know that I've got a lot of pending liquidity here. There's people holding their hand out wanting to make deals, and I need volume to come in and match those. So if I see the price pushing into this liquidity, that means that more of the volume is ask dominant. Doesn't mean it's more buyers or more sellers. It just means it's ask dominant to the point where it's able to push in and consume this liquidity. And the mass of this liquidity, this big ball of stuff right here, gets put into the size of the candle and it goes up. It's like pushing down a plastic bag with a hose attached to it. The air deflates. It goes into this hole. This goes right down this tube, down into the time and sales, and then that pumps up the price. Right, and I'm going to show you guys as well. I've got a really good example of it that I recorded last year. It was a year ago. So let me just pull this over here, and you guys can see it. Let me just rewind it. Okay, this is more for speculation, obviously. It's not necessarily the rags to riches area, but we do teach some speculative stuff in here as well. Let me zoom out so this gets bigger. Look right here at this ask. I'm going to just pause and play it as we go. It'll get clearer as well. But just watch this ask here. Watch how it has... Nope. Watch how it has mass, and then watch the candle respond to the inflation and deflation of the ask. So you see right here, it's kind of a straight line. That's not really ideal. But if this shuffles over this way and we get a nice hill, then the price will go up. But right now the bid is very flat. So it's consuming bid liquidity. It's pushing down. So let's see if it wants to come back up here where this liquidity is. Boom. I don't know if you guys saw that. We'll do it right here. So I'm going to try to do this very quickly. You see how this is starting to shuffle over? You see how it forms this big hill right here? And then you get a price break because the price is pushing up into this mass. All of these pending orders are going to get shoved down here into the time and sales because they're agreements. You see how it just inflated that candle like that? And you see how I got in right at the start of that move? And then it just went right back down. The ask inflated again. Price starts to push up the hill. Ooh, actually, that's a really good hill right there. See the size and shape of this hill? And then watch the price. Boom. See how that got smaller and it pumped up the candle? That is a condition which must be met. It's a market mechanic thing. It's not something that I'm guessing. It's not, I'm just waiting to see if it starts and then I get in and justify the risk. But in order for the price to move up, that kind of has to happen to an extent. So why not just focus on the stuff that matters and not try to put 50 indicators on the chart and hope the price goes up after I buy it because I'm special and I'm the main character, right? SKZ, these are two trades from today. I go for low RR, but I always have a high time frame direction, so I miss out on runs. It's frustrating. Sorry, no screenshot. That's okay. Let's take a look. I'm here for you guys. Don't let me do all the talking here, because I'll just ramble and waste everyone's time. All right, let's move this over here. Okay, so what are we looking at here? This looks like, I assume you're doing like a double bottom situation here. You bought here, sold there. Is that accurate? Nasdaq, yep. But I'm assuming you're catching the bounce there. So let's zoom in. What do we see here? 1, 2, 3, 4, 5, 6, 7, 8, 9 candles with lower highs. Okay? This is an impulse. It's a technical bearish impulse. So we can understand that 90% of the time, 25% of that range is recovered on a bounce. So that's a setup. That's a market mechanic that it's an overextension into retracement, right? But we also have to plan for that 10%. You trade ICT? No, I'm not going to get angry. If something works for you, it works for you. But I just want you to understand that all those rules and all those, like every strategy out there, is aiming to get at the same underlying concepts. So as long as you understand why the rule exists and that you're able to scrutinize it and not fully trust anything, then you'll be a better trader. Hell, scrutinize the stuff I say. Challenge it. Ask, does every transaction actually require one buyer and one seller? Or is it the result of more buyers coming in? Like, how does it actually work, right? Scrutinize it. Call it out. If you're using your ICT concepts in a way that helps you identify your risk, and then you're able to navigate that risk effectively, I will never get angry. But if you're using it to try to predict, then I'm gonna ask you to question yourself on that. You always wait for a little bounce. I mean, I see this right here. You waited until the price was moving up before you got in. That's all you got to do. At the end of the day, that's what everything boils down to. Sometimes price goes up, and when it does, sometimes it goes up higher. That's the number one concept. Sometimes it goes down. You choose how far you're in for. Now let me ask you a question. What would your response have been if this went down? Did you have an automated stop in place? Or were you manually executing the stop loss? Just go for one. Okay. How is that working so far? You're making decent money, I assume? Are you net positive for the year? I guess we'll start there. Okay. So is there any reason to try to change anything you're doing if you're making money and you're net positive? Are you trimming profits and putting them into passive income to grow that portfolio? Or are you just doing speculation right now? Let me look at your other picture as well. Beautiful. I like that you exited this one before it went all the way down. That's good. Now, let me draw something on your screenshot here, or your picture. Okay. What do we see on this chart? What was your justification here? And then who else that's been on my streams can tell me exactly what we're looking at right here? A loss? Oh, no. He traded this to the downside. He took a short position. I'm assuming, right? Did you short this or did you go long on that and then take a loss? I assume you shorted, and I'll explain why in a moment. I'm just not familiar with the notation here. I'm assuming red means you borrowed or you sold, and then blue means you bought. Reasoning for the trade was an inducement, either side of consolidation targeting the downside for the upside in the other side. Okay, so you're trading a breakout basically. A fake out specifically. Okay, so let me show you what I see. You see that? What do you think I'm using to draw that box? What's the rationale behind that? Use consolidation boxes if you're talking about that. It depends on what you mean by that. Are you referring to like this here, or are you referring to these up here? I'm using one candle. Well, two candles technically, but one specific candle to use the high and the low there. The highest, okay. I don't know if that's this one or this one here. I'm using this one right here. Oops, let me switch over to this. I'm using this candle and this candle. That's very hard to see. Do you know why? Based on everything I just talked about, do you know why this move and this candle that started it were worth watching? Manipulation? No, it's not. No, we're going to take all that narrative stuff and throw it in the trash. We're just talking about market mechanics. Not sure? Okay. So let me grab a new... sorry, let me get that off the chart here. Okay. Let me grab a new screenshot. Let me just come up here. Where's my drawing tool? Okay. Here's my drawing tool. All right. So if I want bulk fills in the future, I need to look at where the bulk fills were in the past, right? Remember, I've got an order book, okay? And then that order book has a couple of shapes to it that I want to see, that I could see, right? I've got three possible shapes on the order book. I've got convex, concave, and a hypotenuse, okay? I don't want to trade a hypotenuse, and I don't want to trade a concave shape, and I don't really care about the bid. So I really only want to see the hill on the ask if I'm looking for an upside trade. If I'm looking for a downside trade, I flip it around, and I want to see a hill in the bid. So in this case, let's look at the bid. All right. Now, I can only see this ahead of time if I'm looking at the order book. So in order to see historical moves and historical areas where this happened, I need to look at the candles. Because remember what happens when the price starts to push into that bid and consume it, the price goes down very rapidly, right? Because we've got bid dominant volume. So basically what's happening is as bid orders are filled, this stuff shuffles to the side. Like this point right here will shuffle over, and this just kind of goes down into the hole, and the hole turns into volume, and then that reflects in the candle, right? So for visualization purposes, we're just kind of dumping sand into a hole, right? In reality, we're just slamming into this wall over and over and over again, and we're just filling new price points over and over and over again. So I want to use that to my advantage. And if I need to find those areas historically, because again, we're trying to replicate the past as a speculative trader, we're not trying to predict the future. I need to wait and draw. That's not a box. I need to draw boxes where small candles led to big candles, because that's areas where that's most likely going to happen again, right? And then when the price comes back, all I have to do is make sure I see this, and then I see the price start to leave that area. Easy trade, right? High potential, high quality opportunity, low risk. It's worth taking a shot with a responsible position size in that case. Does that make... Oh, what's going on in that channel? 8x alert. Let me take a look here. Oh, Jesus. Okay. Sorry about that, guys. I've had a lot of problems with him. I'm just going to erase all those notifications. Sorry about that, guys. That's a problem with automation. He's trying to connect stuff to his thing, I bet, his platform that he stole. But no comment. So, all right. So does this make sense, SKZ? Thanks for the heads up on that, Doctor, by the way. I'm not taking questions at this time, Epic. So if we're looking at your screenshot, okay, I'll just grab a fresh version of that. That's exactly what we see. And I'm not cherry picking this. This is what I use every day. It's what I put in the alert channel. This right here was an area. If we zoom out, if we go back in time, let me change the color of that because it's hard to see on this. Let me use red. Okay, yeah, that shows up better. If we look at the order book during this candle's formation, okay, we more than likely would have seen something like this on the bid. And then during this formation right here, this bid deflated. Yeah, I can't stop. That's a problem. I just keep streaming. These guys keep asking all the good questions. It's their fault, really. Let me check my DMs, though, because I do get a couple DMs I gotta... Okay, that is definitely something I'll have to follow up on. Use order blocks at the highest wick. Does that make sense, or is the candle before the down move better? It's always going to be the candle that led to the big move. The reason for that is specifically because of this formation right here. Yeah, what's up, Epic? This applies to higher time frames too. Don't think this just applies to garbage and stuff. Like this is Nasdaq, for example. And because this happened in the past, right? We also want to see that same formation when the price leaves that area again, because this is the move that we want. So again, same setup, same order book. Ideally leads to the same move, which in this case it did. Now again, I'm teaching like volume analysis here. I know this isn't really like a speculative heavy stream, but I do want to make sure that you guys really get a rock solid understanding of this stuff, because nothing else is really going to matter if you're not able to see, like if the move can't happen in the market because the conditions aren't there, you're not going to see the move and you're just going to get faked out a bunch. So we can at least control our potential here and understand what confirmation looks like, because that's always the question I get when it comes to speculation. Because we'll put out a range. I'm like, I'm looking for confirmation above this or below that or off the CMA or whatever, and then nobody really sits people down and talks about what confirmation looks like. And that is, you've got high concentration of liquidity on the side you're looking, and then you see price push into that liquidity. And that confirms that you've got dominant volume on that side. And again, it's not buyers versus sellers. It's ask versus bid dominance. So again, I would much rather see people just use like $20. Just learn the ropes, get the basics down, watch these with no risk for a while, and just see how things work. Identify areas where this has happened historically, because it's likely to happen again, and that's kind of what we're doing. And things will be a lot clearer in the market than if you're someone who's just putting 15,000 into the market and hoping it works, and then chasing strategies. What do you got here, Epic? Level 2 order book is Excel level. Buy or sell price input at the most basic level. They can move and combat all fighting for price, as you say, but why don't we just program an indicator to tell us? Not quite sure what you mean by that. boom, 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 boom. I also want to really quickly clarify that price doesn't move because of fighting. Price moves because of agreements. The only one who fights is the person who disagrees with what actually happens. Yeah, the order book. The histogram on the order book, yep. Are you saying to write an algo that can tell us when there's a hill? You can, but you also want to make sure that the price is moving into that zone. So you can write an indicator that can tell you kind of, which ones may have the best potential, the best looking hills, but these are also going to inflate and deflate at the same time. So if you watch something like SPY, for example, right? Let's look at SPY. This is constantly moving. So whatever screener it is always going to have a ton of these very high activity tickers. So they're always going to sit at the top. You're just constantly going to get bombarded. It's like, oh, hill on SPY, hill on SPY, hill on SPY. So you could, but you'd have to filter stuff out. SKZ says, I basically used what you said, but because we were consolidating, I waited for a sweep of that previously where it reacted for the real move, which was manipulation to the other play I made, which was to the upside. Let me look at your screenshot here. All right, what do we got here? Okay. Yeah, and that makes sense. You're just expanding your range a little bit. But ultimately, what I'm saying is the core of this star basically is this to that. Those two candles. What we need is an indicator that would indicate for a percent move based on the underlying. It's all going to be relative. There's no hard and fast rule there. Because you're going to have different volume on different days. And you're going to have different relative volume on different tickers based on float. So even a percent move would just return low float stuff. What about on your other screenshot? Let me take a look. This one here. That's where I drew that. And then for this one here, again, just looking back here, you've got a good setup right here for when this comes back. You can assess it, but you also took your profit right here, or I assume you would have. Oh, I guess you took it lower, and that's okay. But let's break this one down. Let me just draw on it. Okay. Let's just pull it up here. I'm only looking for small candle leads to big candles. So where do I see? That's okay, but it's pretty big. So we're going to get rid of that one. Don't like that as much. Now this price is skewed, obviously, because you've got candle action happening off the screen. So I'm trying to take that into consideration as well. Like the total range of this compared to this is smaller. So kind of. You also had an angle here, so it's kind of hard to draw horizontal lines. But let's take a look. We got that, but that's kind of a big range. I don't really like that because you've got smaller candles, so not a big fan of that. Let's see. I'm just trying to see. I'm assuming up here there might be something good because I see kind of higher wicks here, but I don't know what the upper side of those candles have. I'd say maybe this one right here. That's acceptable enough considering the local candles. And then this one here, definitely like that. That's a very, very small candle, and it leads to a much bigger move. So in this case, yeah, I'd probably be looking for a downside out of that area. And then down here, obviously, you've got this guy. Well, basically the whole range, but this guy right here is the more important one because he leads to the big move. So yeah, I'd just be looking for that, to that, to that, and just see where it brings you. And obviously if it breaks, you've also got a range to watch for a break. And then you've got another zone right up here. Now again, this is at an angle, and I don't really know where the top is, so you may have a better zone up here, in which case I would probably get rid of that one. So you've got some distance between them, but it all depends. So in a chart like this, it would be very difficult to draw it'd be very difficult to make an indicator for, because there's just so much wick activity. So in this case, because there's so many wicks, I would change time frame. This is a very messy chart. It's very difficult to read, and I feel like you can get better ranges on a different time frame, probably a lower time frame. That's the top. Okay, yeah. So then up here then would have been your better opportunity. So you've kind of got this area, and then that guy, and then this guy, and then over here you got this guy. And also where it rebalanced exactly where you said to go further up. Right here or down here? Did it do that? I didn't look at the chart. Prediction. I mean, it's a possibility, right? It's saying it has a likelihood to do this, but there's no guarantee. So actually, let me pull up TradingView here. And the people that were with us in Nashville, the Traders Paradise people, they got an indicator that I made for those ranges. Let's just wait till it pulls up here. It's taking a while for some reason. Don't know what that's about. Okay, so I'm still getting internet. Why are you upset? What's going on? Let me turn this off. All right, so let's see, what are we looking at there? Let's look up SPY. All right, so we'll kick it up to the 5 minute on this, so there's fewer signals here. So this one has a couple different features in it, but the basic idea here is that we use these zones as break zones. And if you zoom out, you can kind of see more often than not, the price will respond to those zones over time, whether it's to the upside or downside. And when you get clusters of these zones, that's when you can really, really look at those areas. So like right up here, for example, if I draw a line or a range, I'll just draw a line. Just give it a little bit of plus and minus there because I'm just drawing a line and there's a range there. And then we come back here, you see how it bounced right off of that with intent. And when I say intent, I mean, look at the size of this candle compared to all the candles around it. That's the kind of move we're looking for, and we just want to catch pieces. And we don't need grand slams all the time. We just need pieces. We bring this up to the 15 minute. So just general ranges here. Let me look at your screenshot again. Sorry. Okay, which off of here, off this this range right here. Let me draw that. You're referring to this right here, and then it kind of re-challenged it, or were you talking about up here? I drew those so crooked. All right, so let's just break this down. You've got this guy. Let me draw the boxes. I'll just use the actual boxes because it'll be easier. So you've got that guy, and then you've got this guy, and then you've got this guy, and then that's pretty much it. Like this guy here would count, but he's right next to this guy. Oh, cool. So it worked out. That's good. I should do this for a living. That's just because of the same mechanics, right? So you can add whatever other layers of analysis on top of that you want, but ultimately it's just saying because this move happened, we can reverse engineer that, and we can say, hey, we had a bid hill, and we consumed all that liquidity and the price pushed down, right? So when the price comes back, this is still active, and there's still likely going to be bid activity, bid dominance, and it looks like that just got more and more intense. Like if you look at that, compared to that, compared to that, this is an increase in aggression. Okay? And then here, you had a little bit of stagnation before it led to that bigger move. So you had some indecision here, right? But ultimately, you had an area here that had bid potential, right? And then it consumed that potential. And that impacted the candles down, 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 all the way down to here. And then at some point, there must have been ask hill, which got consumed, and the price went up right into this area that we just identified, where the bid presence was, right? And then we slingshot right back down to this guy, where the ask dominance is, and we push back up. Oh, couldn't make it. Push back down. And we got enough consumption down here to finally push up back into here where there's bid dominance. And then in this case, since we had maybe that little bit of extra, we maybe pushed a little higher, maybe we didn't. I don't know. All I know is that if I just look at where it leaves these zones, okay, I can see here it left the zone to the downside. Here it left the zone to the upside. Here it left the zone to the upside. Here it left the zone to the upside. Here it left the zone to the downside. Every time it did this, it did so with violence. And that's all I care about. I don't care which way it goes. I just care that it goes with violence. So if I look at these zones, the implication here is that the price will not stay here very long without causing some sort of violent move in the future. So when price revisits these zones, I know that I can look for very specific things in the form of an ask hill to the upside, followed by price moving into that zone, or a bid side with price moving into that zone and the price pushing down. How do I determine if OBS, what do you mean, order blocks are valid from OTE, if you know what that is? Not sure which acronym you're referring to. Order blocks, obviously. Go ahead and spell it out for me. It's been a little bit. The only way you can know if they're valid is if the price reacts to them. If it measures. Oh, okay. You're talking about discount versus premium. Okay. So in that case, it's just layering things on top of market mechanics. So I assume you're talking about the distance that it moves from this zone. Like using the length of the impulse to determine whether or not the strength of the order block. Okay, so you're saying it's above. Okay, so basically, for those who don't know or are not familiar with ICT, basically there's like a divider between a level determining whether or not something is available at a premium or at a discount, meaning that it's either a good ratio or a less good ratio. So I don't think that really matters at the end of the day. Other than just your own risk management, that's not a reliable predictor of price, because ultimately price is just going to go where these changes in liquidity are. They're just pushing into zones. And you can see, even in that case, it still breaks. You've still got price action above and below, nullifying these. So you've got, like this is a distribution gap right here. This is a distribution gap. And this is the volcano that compresses and crushes that diamond. Yeah, it's all algos. You just know that there's areas of appeal that the algos have determined they're more willing to participate at. So think of these like shelf prices, right? There's a lot more activity at these levels for a very specific reason, and that's because they have the best appeal to the algos. It's not because people want the price to go up or because there's more or less sweepability in a certain area and so on and so forth. Like you'll see all that stuff on YouTube, and then you'll go to try to apply it on your own, and you'll just get hurt, right? And that's the experience for most traders. I'm telling you, just set it all aside for 5 minutes. That doesn't mean you can't use it. It just means set it aside and look at what causes those things to be valid or invalid. 10 a.m. usually, yeah, I mean, that's going to change too. I mean, just, it's very hard to get away from confirmation bias, right? So give me a ticker, any ticker. AMD. All right, let's look at AMD. I'll pull this back up over here. So if that is a rule that we can use more often than not, we can expect some sort of reaction at 10 a.m., I assume Eastern. So let me pull up AMD, and we'll look at the 10 o'clock mark. And at this point, it took about 20 minutes for that bounce. But we did get a continuation at 10. So going in at 10, we kind of had a little bit of a bounce, right? And then it just continued down. I would consider that not a reaction in that case. We had low volume at the 10 o'clock mark. So if we use the opening range break, for example, the 15-minute or even the pre-market highs or lows, as you'll see on YouTube, we should see some sort of retest or some sort of something happening there. So let me kick it back down to the 2-minute. Price was nowhere near that. So no retest. Let's do the fair value gap approach, right? Did we get a fair value gap? Sure. Did we get a move out of there at 10? A little bit after, yeah. But is that significant? No. Let's look at the 1 minute. Do I get some sort of candle pattern to validate it? Like, how far do I have to look at this before I tell myself that it's valid? Right? In theory, we should have gotten a retracement up into this box. We didn't. We didn't get it all day. That's what the opening range break is supposed to be. You have your first 15 minutes plotted, or the pre-market highs, whatever one suits the agenda afterward. And then you get a push up into this test, and then you get maybe a fair value shoot out of it, right? And that tells that, okay, it's settled. There's a lot of momentum now. We're going to leave this zone with violence. That's the general approach to the orb. And it just doesn't work consistently enough to use compared to other things that kind of make a little bit more sense. Let me come over here and look up NQ. Oh no, I gotta do daily. I don't have the subscription on this. Sorry. Also, let me turn that indicator off. Yeah, I don't think I'll be able to pull that up. Maybe a Ninja Trader, I think. Oh, yeah, okay. Weird. All right, you give me a time frame. What time frame? 1 minute. All right, that is super low. All right. Okay, so we're on the 1 minute. We're going to look at the 10 a.m. mark, and we're going to look for reaction on Nasdaq. Oh, B, draw vertical line. Okay, what do we see here? I don't see anything, right? So again, if we drew the opening range break, what would we get from here to here? We've got 945 right here. Okay, let me draw the range there. You know, we get a little bit of a retrace, a little bit of a touch here, right? But at 10 o'clock, we were already kind of moving away from there. So, you know, we got the retest technically, but you know, what kind of retest are we actually seeing here? I would much rather see this and then it followed to the downside. Didn't work today, of course. Let's look at the past few days. All right, we'll go to the same thing here. Okay, let's look at the 10 o'clock mark. All right, and then we'll draw the opening range break here, 945, which is up, yeah, and the low is right now. I see a pullback and then continuation. Then I see a much better retest later on in the late morning. Ooh, is this going to go up or down? Oh, it looks like it went, oh, is it going, oh. We're going up or down? Looks like we went up to today's opening range low. We got in that range. So, you know, let's look at another day. Right? Let's remove all the drawings here. And again, I'm not trying to like poop on any strategies or anything like that, but I'm pointing out that confirmation bias is a hell of a drug. And it's very, very easy to fall into seeing someone do something with confidence and seeing a big number attached to it, like online, and then actually scrutinizing what they're saying and confirming that the thing makes sense, right? So I can give you a very easy strategy right now. Just buy any green candle and then sell the next green candle. Or if it drops below the green candle, stop out. That's a very easy strategy. And as long as you limit the size of those green candles which you're buying, you could be net profitable over a series of trades. And you probably will be, right? It's just the way that the market works. But if you're looking for bigger moves and trying to predict, then it's just going to hurt. So I just don't want to see you guys fall into that stuff. That's all. All right. So right here, we got the opening range break. We got a retest of it, followed by continuation to the downside. Great move. And then it gave it back, but great move, right? Is there a better way that we can get the same quality move without using arbitrary things like some sort of time cutoff? I say yes. I think there's a much better way. A cleaner way. I won't say better. So let's remove these. And now I'm going to challenge you to check the boxes. So we'll go back to, we'll start with a couple days ago, right? We'll just, what was it, this day? Sorry, I got to zoom in all the way. I really hate the 1 minute. All right, so if I just plot boxes, I'll use the price ranges here, for prices that lead to big moves, like this guy right here. Now that's not really a small candle, so it's kind of shaky, but I'll draw it anyway, just for fun. Nope, that's the wrong tool. I'm definitely new to this, guys. Okay, right? Is that fair? I'm not looking at stuff ahead of time. Let me zoom in over here. I'm just saying this is a small candle, relatively speaking, that leads to a big candle. All right, so let me see. I got one right here as well. I just draw the box. I'm trying to be as fair as possible about it. We already got another retest right there. All right, let's see. Do I see any other small candles that are far enough away from these two that lead to big moves? Gonna kind of zoom out a little bit here. Okay, do I get a... Okay, I like this one. Decent move. I could draw these two, but they're very, very close. I just don't like doing that. I'll draw this one and then change the color of it. But I typically just ignore those. Okay. Now, what else do I see? I kind of like that one. It's pretty close, though. Again, I just don't like really drawing them too close together, but we'll draw it just for the sake of drawing it. And that's an orange. So I got these zones, right? And if we just look back through this day, okay, we drew this box first. We got a retest, and then this box formed before that retest. And then the price moved from that box to that box, and the price moved from that box basically back to that box, and then it moved from here back to that box, right? So we know where the participation is, and we know that we're getting violent reactions out of those areas in some cases. And then here we've got a little bit of dip below, but not really a significant move. We just kind of got some chop here. And then the price left this zone many, many times, and then it finally just shot out of here and went straight to this box, right? And then at this point, we've got this box to contend with, so we didn't really get a strong move down. And then here we got a strong move to the upside, and then we formed this little area here. So now this box is in play. And we pushed up to this box, which again, we may or may not have drawn pre-market, but I wouldn't have. So let's assume that we didn't have this box yet. We drew it here, okay? Price went up here. We don't have this box yet. Price comes back to here. We now have this box. Price went from that box to that box, right back to that box. Price showed a little bit of a move there, but we wouldn't have gotten a full move. Price went back to that box and then back to that box. So box to box to box to box, right? And then price shot from there to there, shot from there to there to there, there to there. It just keeps going. And then we rejected violently from down here. So we kind of know where the price is likely to be contained. And then all we have to do is look for those little setups from one box to another in the volume. And this gives us structure, right? Now let me get to the next day here. And I'm not going to draw any more boxes. Normally I draw them per day, but let's just see where the price starts to react if I zoom out. You can see we got a little clustering here, a little bit of a pivot, a little bit of a bounce here, a little bit of a cluster here. Huge move to the downside out of that guy. Huge move to the upside out of this guy. And then we're up here. We get a nice push, a retest, a test of this box here, and then the price bounced right up out of there. and then we couldn't quite get back to this area, so we would need more local boxes. Now, the 1 minute time frame is the worst possible time frame to draw this on, unless you go to a tick chart. So if we were to refine that process and go just a little bit higher, use a little bit more discretion about the boxes, and to understand that we also have extended hours because this is the Nasdaq futures. So if I just draw this here because it leads to this move, and I draw this because it leads to that move. Okay, and then I don't really see much else. I see this guy here, but that's pretty weak. So let's see. Do we get anything? Sorry, I'm just kind of zooming out. Yeah, we get a nice, it kind of catches the price here, and we get 2 decent enough moves to the upside here for small profits, and then we can let the other portion of that scale out if we want to. Just like we talked about earlier with the phase 1, phase 2, phase 3. Now these 2 boxes, if I just kind of zoom out here, you can see that the price kind of hangs out between them for a good chunk of time. Sorry. And then it kind of does the same thing down here. So I'm willing to bet if I draw a line right here, okay, and then I zoom in, I'm willing to bet I'll find a small box that leads to a big box. Probably right here. And we do. So let me draw that. Okay, now let me also just kind of zoom over here. You see a nice little bounce out of that with some violence. Retest some violence. Straight shot through, so no trade on that one to the upside. And then let's see what else we get. And a nice clean bounce out of that. So less is more in this case. If you want to just go up higher and just trade more common sense ranges than the 1 minute, you'll have a better time. Yeah, I really, and here, for example, I can tell because this is a huge displacement. I guarantee there's a small candle that started it. So, you know, in this case, we've got this little guy right there, little troublemaker. Right, so if I look left, I can see that that level is respected and has a history of violence. So therefore, it's a valid level. And if I come back over here, you can see it acted as a ceiling here. And then the price obviously pushed through and then just didn't sustain, and it went box to box almost immediately. So again, I don't want to go down the speculative rabbit hole so much, but just understanding that there is a way to do this without making things complicated, or using indicators up the wazoo, or having a bunch of theories. We understand that in order for price to move, there has to be liquidity, and it's usually more beneficial to a trader to take all the narrative out of these strategies and then see what's left. So if your strategy is saying buy here because buyers are stepping in, or buy here because they're fighting over price, discard that part of the strategy altogether and see what's left. So order blocks, for example, there's a narrative behind those. Fib retracements, there's a narrative behind those. Fair value gaps, there's a narrative behind those. And instead of looking at the pattern itself, look at what started it. Look at how it works. And you'll have a much better grasp on price movement. Does that make sense? Exactly, Doctor. We complicate things way more than we ever have to. And I know by saying those things, I'm going to make people upset, but at the end of the day, is your strategy working for you or is it not? If it's working for you, great. But I'm willing to bet that's more because you're just getting better at managing your risk than anything else. So I just want you guys to succeed, and part of succeeding is just cutting out all the stuff that confuses you and makes it difficult to push the button. Yeah, what's up? You can always make your point. All right, you guys, challenge me on this stuff. Call it out. Say, no, Pookie, you're wrong. Fair value gaps are the way. The entire market is just exit liquidity. Yes and no. I also don't personally agree with the term exit liquidity unless you're referring to one actor. Like on a one-to-one sense, yes. Every time you sell something, you are providing exit liquidity. Every time you buy something, you're absorbing exit liquidity. I get what you're saying, though. Everyone is just, the bigger players are harvesting money. And that's the whole point, is all these institutions are just trying to compete and consume each other. And then retail traders just jump in thinking they're the main character and get just chewed up. So. Yeah, exactly. They put this little glowing ball here, for example. This little flash, it makes you feel stimulated. They put the graphics in here. They make you, they flash these things when they change price. All that. It's all just a casino. It's to make you lose sense of your risk perception. Because once you lose sense of it, your risk perception takes over, and therefore you're impulsive, and then you're willing to just give money and take risk without the same perspective. Yeah, absolutely. But if you treat this as a non-ergodic process, and you understand that negative compounds against you way worse than positive compound works in your favor, until you figure that out, you're going to have a really hard time. So you can be fussy as you want with your money. You could keep it very, very simple. That's why I've just been harping on this past week or 2 weeks. Literally, no hill, no trade. If price isn't actively climbing the hill, there's no exposure. If the trade doesn't go in the direction you want it to go, you can always just cut it, get out. There's no more PDT rule. Well, there is, but not like that. There's no more restriction on the number of trades, so there's no pressure to see a trade through to the end unless you're just trying to be right. Obviously, you still have slippage as a concern, but or if you're in a commission broker, then you have issues with that. But then you just kick it up to higher time frames and take more stable trades. Same concepts, but you're taking them over longer periods of time to reduce frequency. Like this right here. This is a level that I've identified. The price is moving up, but this hill wasn't there a minute ago. So I wouldn't trade this. Now there's a hill, so maybe, but I'm not actually trading it. WETO. There's a hill here, but it's not moving up, so no trade. FMFC, no hill, no trade. RAPL, no hill, no trade. MGRX, flatline, it's a hypotenuse, no trade. ZEO, that's a concave shape, avoiding that like the plague. TCX, there's no hill until we're above 16, so let me draw a line above 16. That's above high a day, and it's a Friday, and it's almost 3 o'clock. I don't think we're getting that. CIGL, that's a half pipe, leaving it alone. This one here might be decent above $1.27. TGHL. And then what you can do is you can look back. Once you identify those areas, just look back and see how price behaved off of those levels. It's the same freaking thing. Right? It's just before or after. Right? You get big moves off these levels in both directions because that's where the algos are. Now I'm on the 30-minute, obviously, so we'd have to look at the lower time frames to see the actual bounces, but you can see it's reacting to that level. These levels aren't new. They just get repopulated when the price gets closer to them by the same algos. Does that make sense? APMD, no trade. There's no hill until we get above 26.12, which is up here. There, somewhere around there. So trading doesn't have to be complicated, especially on the speculative side. Now, if you're looking for swing trades or long-term trades, then you have to have reasons for what you're doing. So again, technical analysis does matter, but it doesn't predict price. It tells you opportunity versus risk, and if you can't execute based on those, no strategy will help you. No indicator is going to help you. So instead, we got to focus on our responses to things and changing the way that we perceive risk. So I'm done rambling. It's about 3 o'clock. So I got to get off of here. It's horoscope at best. Tell them the truth. Kind of, yeah. We've seen it all the time. Even if a company does spectacular and they get really good earnings and they're making a ton of money and they're keeping money and they're sharing it with the investors, the stock can still tank out of nowhere. And vice versa. You can have absolute garbage stocks. We see that every day. These are blasting. This is a garbage company. All these are garbage companies. But they're up hundreds of percents, and that happens every day. It's just because of where the volume goes. Exactly. Yep, $5 stock. Absolutely. And that's what I'm saying. Like, definitely use technical analysis. Learn enough. Don't learn all of it. Trust me, it's a waste of time. Learn enough to keep things understandable and use it to identify your risk above all else. If you try to predict price with it, if you don't have a plan for your profits to trim them and put them into passive income so that it can compound in the background, while you're keeping things in familiar ranges and expanding your tolerance, you're going to have a very hard time in the market. So I've given you guys a lot of juice here. I want you to chew on it. I don't know why there's pulp, I guess. I don't watch the recording over and over again. I'll upload it and I'll put the link in the Rags to Riches team chat, and we'll go from there. I do want to get the Rags to Riches team members into their spreadsheets, though. I know I said that we were going to do that a while back, but I actually want to start that so we can get them rocking and rolling. I've had a couple one-on-ones with some of them already. So with that said, I got to jump off here. I appreciate you guys all hanging out. Hopefully it made sense, and hopefully nobody's too upset over the things I've said. But at the end of the day, it's mechanics. Sorry. So, all right. I'll see you guys later. Thank you all for hanging out. And we got a half hour till the premium wrap up. Adios.